Measurable means we are talking about numerical values, and that is what we have. So the first case that we look about here is we talk about the process here in project management. We are supposed to enumerate, so I can write them down and then explain. When we talk about a project comprises of series of activities. For example, you want to put up a factory, you want to put up a machine, even a posho mill. You have to evaluate what is the likely return from this my posho mill. That is, from the start, you have what we call capital investment. How much is the machine or posho mill costing, and so on. So the project management is that, in this case, what's the likely returns for my posho mill first year, second year, and so on. That is what we'll be calling project management. Even if you talk about putting up a rental building, you must have first incurring the capital cost there. What's the likely return for my business? How do I reschedule whatever I have that I have now to put up a building? Instead, maybe posho mill. What can I do? Posho mill might give me quick return, or that. That is, in terms of computation, we apply quantitative analysis for that. That is one aspect where we can apply the quantitative analysis in business, because even if you have plots and the rest, these are business entities which will generate income for an individual, so they are helpful in business. Number two, we have this one in the production. Production management is one area. Production means that we have to talk of the so-called the inputs and the output. The raw materials, how many bales of cotton lint are needed for this case to produce an output of a given kind of shirts, which are cotton or what. So that is what we call production management, because for every production, there is always what we call input and then output. Therefore, in quantitative analysis, we have that particular topic which is referred to as input-output analysis, so that you can find how much raw materials are required to produce a specific output. That is production management, and we are deploying the skills of quantitative analysis, raw data and the output, raw data and the results. Remember, there is also the cost, because for you to have raw data, you acquire them from another sector. Therefore, this input-output analysis purely deals with the inter-sector relationship. How much do I depend on the other for me to produce? That is production management. Next, we have marketing. Now, in marketing, you have to purely handle the area of taste. You have heard several times whereby we have people have to go and advertise. The purpose of advertising is simply to find how much is the advertising impacting on actual sales. For example, if I talk about putting an advert for a sale of, say, cooking oil, how much do I have to spend on this particular item, and how much do I actually realize at the sale? The major idea here is to employ the idea of correlation. So the correlation will tell you whether you are spending more on the advert, and also the actual sales are also more. That will show you that there is positive correlation. If there is no positive correlation, then it is pointless to do extensive advert, because at the end of it, you may not do or realize your expenditure in terms of income. So what I'm saying is that under quantitative analysis, we have various sections that will be useful to analyze and apply to various sectors, because now for the marketing, you need to know how much is the advert affecting the actual sales. How much, for economists, is the savings connected to income? So that you can see how is the economy stable or what. That is still under correlation, and if by extension, you can now talk about regression. All these are now for focusing purposes. But remember, we are talking about marketing. How much do people prefer our bank? As you are a bank manager, we have marketing department, any other, Safaricom, the service industries, all those are related. So we have marketing also deploying the skills of quantitative analysis. The fourth one we have here is what we call finance. You know, finance sometimes is difficult to that. So accountants use different quantitative methods to do forecasting, because if you talk about projection in the companies, then you have acquired an asset. So the accountants can use the techniques like the rates of interest to do discounting. Discounting will actually help you to determine the actual return of this particular kind of project. Just remember, we talked about production and the other side project, but the discounting factor, the knowledge of discounting factor, rates of interest that is actually available, should be able to assist the finance or accountant in determining the viability, because we have the viability will be having that what we call net present values and the rest. These are out of discounting factors, and therefore they are quantitative in nature for their computation. They'll have the finance section, and therefore we say that quantitative analysis is applicable to finance section and can be used from the particular area of discounting in terms of returns of investment. Therefore, finance utilizes the quantitative analysis techniques. The fifth one would be for personnel management. This one is where we talk, currently we don't talk about personnel officers, but we talk about HR, human resources managers or officers. They need to know how much do we need to retain, how much people, how many employees, the staffing for that matter. Now, if you look at the quantitative analysis, areas such as Markov analysis, Markov will show that how much do you have as exit. You know, in employment, we have exit and entry. How much do we have as exit? How much do we need to retain as a stable staff size? So that for every exit, due to maybe retirement, dismissal, sickness, and the rest, how much do we need to employ? Therefore, under the skills of Markov analysis, the HR people department can determine the stable size of staffing, and if possible, even upward mobility by training them or what we call capacity building. Therefore, it is important to note that even personnel management, which is particular human resource management, employs or applies quantitative analysis technique. It may not be all that simple, but in general, we know that, for example, right now, the government is not employing, or in particular, if say Teacher Service Commission, each and every year there's always a fixed number advertised for a teachers, secondary school and primary school. In effect, the size of labor force TSC remains the same, round off around 300,000. So which means, what's the plan for the exit and what's the plan for the entry? That is in particular area of Markov analysis, that is quantitative analysis coming in. Now the other one I can talk about is agriculture. Remember, they are using tools which are mainly quantitative in nature. So when we talk about agriculture, the farmers can use decision theory in that we can now see what are the prevailing conditions. We are here in the month of September. What is the prevailing condition? In this case, as a farmer, do we have adequate rain? And if so, with that assumption of the flow of adequate rain, the farmers can adequately determine the kind or the right crop to plant, given the fact that if you're in short rain season, there are certain plants that may require only short rains or little rain for that matter to mature up. So the knowledge of decision theory, and in particular maybe the states prevailing long rain, unfortunately because of the climatic changes which are experienced all over the world, it has become very difficult to predict how much rain we expect particular point. But what we are saying, in a normal circumstance, if farmers would be able to determine the prevailing condition, they can predict and focus the kind of crop to put up based on prevailing conditions, weather, as well as their ability, which is the strategies as how do I need labor force or farm machinery, all that they can help. Finally, we have this, this is not final, but I have this 7. I can have this area, what we call the purchase and inventory. This would be under what we call inventory planning and management, purchase and inventory. Now you see in the operations of production, there is always the acquisition of raw material, there is the time, the lease, or whatever we need. Now, with the knowledge of quantitative analysis, I think the farms can be able to determine how much to stock, how much to acquire, or how much to order, and how much it will cost. So all those management control and inventory control, they'll be utilizing the techniques of quantitative analysis, and for that matter, it is important that inventory control or purchase or procurement, they require the knowledge of quantitative analysis. And the last one is, we call it research. We call it research and development. Research and development. Now, what are you saying? That managers can use mathematical techniques to determine eventual profitability in certain inputs, or what we call managers can actually determine the profitability of new products, may say in the market, in terms of probability of their success or failure. So with this, you can now see how much can we now develop for this kind of product. Because if we talk about maybe a new kind of maybe like the consumer industry, we have various kind of goods, be it in the cosmetics, be it in the cooking area, be it in the textiles. All this with the probability of success, the research can be conducted and predict what kind of item you can engage it. And therefore, with this, among others, remember the various techniques, even regression, correlation, and linear programming. They are all these because in linear programming, we talk about personnel management under what we call the assignment problems, and those ones, those not in the new syllabus, but then they are all coming, personnel management still under Markov and even assignment, they're all under the quantitative analysis areas. So for that matter, these are the summary of various areas in which we can apply the quantitative analysis. And that is all we have. Thank you very much. As I said, we are handling only that question 4A. Question 4B, we are not looking into it because dealing with game theory. And question 4C is dealing with the queuing problem. The 2B and C are not actually retained with the current syllabus. For that matter, we are not going to do those questions. We only have to handle question 4A, which was enumerate 8 applications of quantitative analysis in business, and that is 8 marks. So we stop there for that question and move on to the next if there is any other that will still be retained in the current syllabus. Thank you very much.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lengwiri, and today, ladies and gentlemen, we are discussing about the Business and Data Analytics August 2023 paper. The question of focus today is question 22. It reads as follows. Riziki Limited is considering a project with the following details. Initial cost, 40 million. Residual value, 2.5 million. Selling price per unit is 1.1. Variable cost per unit, 500. I meant 1,100, pardon me. The variable cost per unit is 500. Fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs, or the major inputs towards the right. Like for example, what I mean is this. We are going to now talk about the base. Here we are going to talk about the base case, input based on the input, so base. That. And then towards the right, we are going to include a 5% initial cost, or positive value of 5% initial cost. So we are going to have plus 5% initial cost, like that. And then we will now then have the adverse scenario where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now, increase in variable cost. 5% variable, 5%. I'll explain variable cost. Variable cost. And then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here, of 5% a variable cost, and then residual value. There, so negative 5%, negative 5%, residual fixed cost. I think I forgot fixed cost. So positive 5%. Apologies for that. Positive 5%. 5% fixed cost. And then we're talking about residual value right here. Residual value. %, residual value. That. So with that, we are saying that we are told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million. And we come down there. So we want the comma format, guys. The comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value going down. The residual value is given to us over there. That value there. Because we talk about the base case. And then the annual unit sales. The annual unit sales you can see is right here. Additional information number 1. So 30,000. So just put plus 30,000. Because this is in words, it's not separated from the words. So it's in figures combined with the words. So just put 30,000 there. We have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there. Enter. Then the fixed costs per year have also been given to us there. So plus. Enter there. The project life in years. We have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, we can put 5% over here because we're saying it's going to be 5% increase over here. So we put just 5%, and we increase. So this will all require this to have percentage. So allow me to do this, to do the following, to put this as percentage over here, comma format here, that. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, then I can just do away with that. Or rather, I can just put them beside the questions over there. However, we can just do away with them for now. So with 5% increase, we just come over here plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us, 42 million. With 42 million, we are saying the residual value remains as the way it is over here. Because we're saying that the residual value will remain as 2.5 million all through, whether there is going to be an adverse effect or so on and so forth like that. So here is 2.2 million like that. We proceed on, and even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1100 like that. So I can just copy these values as the way they are towards the right there with your permission. Because we are saying that the initial cost is the one that is only increasing. So here, just a copy, paste special values. And I say okay, like that. So if that's the case, what happens when we have a decrease in unit sales? 5% decrease in unit sales, because we're saying from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5% like that. You can see it's even indicated to us over here. So here we are saying is going to come back now back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now right down over here we can now do the workings effectively. So I can say plus that value times 1 plus it should be because we're decreasing this value over here 1 no so I think this is the formula. It's plus that value. We're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1, decreasing it means, so it's going to be, we're subtracting it from 0.05, so 1 minus 0.05, that. It shouldn't give us 1 minus 0. We talk about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us them. It should be able to give us take us back to where we actually were before, or there. So it should be just 40 million. That. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price the variable cost is going to decrease over here. So we put negative 5% in terms of selling price. Sorry, so negative 5%. So we put that, and it remains the same over here. I'll explain. that. If you talk about the variable cost itself, also, it also remains the same like that. So it's going to remain including the residual value like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive, positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so, up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times, open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item, talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. And so it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because we are saying that the unit sales are the ones which are being affected. The sales, we are dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change. That part there is going to change, pardon me. That one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we're saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, and we enter. Then we remain with enter. We have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to remain 5 years. Just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we are going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. Base, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because you're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill, Control R, with the exception of this one, where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here, total sales plus, from the question, just to clarify over here, one second, I get it. It's just going to be this value of here, selling price, times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. We just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. Remember, it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with the permission, I'll just move this a bit towards the right. For here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. Put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we're going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative, put it like that, then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. The total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here, and we say that this variable cost component over here is going to change by an increase of 5% increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as follows: 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5,250,000. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. Or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus minus, which comes to plus. So I should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million. Control R. Move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in. So we just put it in there. So the residual value year 5, so we can put it year 5 is a cash inflow. So how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So Control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1 times cash flow. Times cash flow. Which cash flow? These ones here. So we'll do the same, PVIF year 2 times cash flow up to year 5. So year 1, year 2 So I'll just change this. It's going to be easier to change that. Year 3, year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here we put that, and we 12%. So it's going to be plus the cash flow and then we are discounting it. Discount it against, open the brackets, 1 plus that value, close the brackets, power 1 times, not times the cash flow, it's already been multiplied like that. So we enter. So once we have that, we shift Control R. That is year 1. Notice what I've done over here. You can see even the formula is power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flow, so it's going to be plus that value over 1 plus that one, power 2, that. Then you do the same thing. One plus R power 3 that. So here is going to be this power 3. Yes, power 3. So power 4. Sorry, I was just having some trouble with the mouse. Sorry. So plus the cash flow over, open the brackets, 1 plus power 4, that. Then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, then the cash flow is going to be plus that value over 1 plus power 5. Enter. So Control R. Then we have what is called the residual value. Residual value. So you can say PVIF, value interest factor, year 5, times cash flow. That's what you do. So this is residual value. I should change this to enter. Just to do that. And we're saying that the residual value was what value? Residual value was that one over 1 plus that value power 5. Please note it's power 5 because there's a cash info that is coming in at the end of period 5. Just to confirm that it's okay. Yes, that's okay. So from there, we get the total PV. And I can just be able to indicate it using a bottom border, thick border, the bottom, thick border at the bottom there. You can see that we're getting the total present value. Present values is going to be those ones there, like that, up to there. Then I just drag it towards the right, Control R, it gets the total, and I bold that, Control B, as well as this one I Control B, like that, to show that that's the total present values. But remember, part A is requiring us to get the net present value. You can see here, compute the base net present value. So we need to deduct the initial cash outlays. So initial cost, you're saying plus, should I say plus or should I say minus? So you say minus that value. The initial cost is there. So 40 million. Remember, the initial cost over here will change. This value here will change based on whatever you calculated over here. You can see it's 42 million. So we just change Control R, that, we get the NPV. Put it, Control B, then you put a top and bottom border, plus then it may not be very clear, so I put that thick border there, and then I put also this other border here with the permission. It's just presentation, good for presentation, characteristics of good financial models there. So with that then, we have the scenarios. Part B, carry out a sensitivity analysis for NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital there. So the base case, so we'll have, so part B, I can do it just down over here. So the base, we just almost like sort of copying this. Down over here. Then we have the NPVs down here, because we have the NPVs given to us over here, and net present values. NPV. NPVs. So just pick those ones. Then once you pick one, then you just drag it. With that, we can then just now, we've done that, carry out a sensitivity analysis, we've already done the sensitivity analysis, prepare an appropriate chart to indicate the different NPVs. So part A was to compute the base case NPV. We have already done that. The base case NPV is this. Then from there, we are told part B to carry out a sensitivity analysis of NPV, assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Adverse effect. So the initial cost, was given to us over here as 40 million. So we've done an adverse, the opposite, the adverse, by increasing it of, by increasing it by 5%. So we've increased it by 5%. Here we've reduced the unit sales by 5%. The selling price we've reduced by 5%. So we're trying to answer part B, carrying out a sensitivity analysis assuming adverse variance of 5% for all inputs except project life weighted average cost of capital. Yeah. So we cannot have an adverse effect for the initial cost. You cannot, unless the cost is an adverse effect, it means that the initial cost increases in value. That's what we mean. It cannot reduce. If the initial cost reduces, it means it's an advantage to us because we are spending less. You get the point? So the unit sales is now when you're getting a negative value over here. The unit sales decrease. The selling price also decreases here. The variable cost, because it's a cost, the only way a cost can be an adverse effect is if it increases. That's what you're saying. A fixed cost is, because it's a cost, if it increases is when it becomes an adverse effect. For residual value, becomes an effect when the value actually decreases. And that's why we are putting these values differently there. I hope that point is driven home. So with that, then I'll just go to part C here. So we've done a sensitivity analysis for the adverse effects of initial cost, selling price, fixed cost, variable cost, and residual value. And then we are told to prepare an appropriate chart to indicate the different NPVs, each scenario in B above. So what we'll do, we just go towards the right here. Towards the right. And we come and we move on to insert. Once we go to insert, we can come to recommended charts. Click on recommended charts. And you can see whichever chart pleases you, you can be able to recite it, so long as it yields whatever we actually need. So this one, maybe perhaps select this value here, this one. And we say, okay. So the different NPVs that, or the different sets of, or the adverse effects of those values, base case, are actually indicated to us over here. And this means that at the base case, we are actually over there. The initial cost sensitivity plus 5%, because it's a cost. Any cost should be, an adverse effect should actually increase or get a positive value. But any positive value or selling price or what we are selling should actually be indicated by a negative sign if it is going to be an adverse effect. So these are the NPVs based on the initial cost, the annual sales, selling price, the variable cost, and the fixed cost, as well as the residual value. So this, ladies and gentlemen, brings us to the end of question 22, business and data analytics. We hope that you have enjoyed being with Manifested Publishers. Thank you and God bless you.
Greetings to you all candidates. Today I'm going to answer question number 3, advanced financial management. The sitting is November 2020. Question 3A, I read, explain the differences between the following terms as applied in mortgage and financial markets. Roman 1, primary mortgage market and secondary mortgage market, 2 marks. Roman 2, fixed rate mortgage and adjustable rate mortgage, 2 marks. Roman 3, lien and recourse, 2 marks. We'll first give the difference between primary mortgage market and secondary mortgage market. Candidates, the primary mortgage market is where prospective homeowners connect with primary lenders to secure mortgages for both owner-occupant and investment properties. Whereas secondary mortgage market is an expansive arena in which financial institutions and investors buy and sell mortgages. And the goal is to provide a reliable source of money that alleviates some of the risks associated with owning mortgages. That's the difference between primary mortgage market and secondary mortgage market. Roman 2, fixed rate mortgage and adjustable rate mortgage. A fixed rate mortgage is a mortgage loan for which the interest rate remains constant throughout the term of the loan or the term of the mortgage. Whereas the adjustable rate mortgage is a loan with an interest that changes. Lenders normally charge lower initial interest for the adjustable rate mortgage than the fixed rate mortgages. So candidates with the adjustable rate mortgages, the interest rate and the monthly payments change monthly. They may also change quarterly. They may change yearly and so on. So that's the difference between fixed rate mortgage and adjustable rate mortgage. Roman 3, lien and recourse. Now, a lien, candidates, gives an individual or an entity a claim to a property until a debt is paid off. And if the debt goes unpaid, they have the right to take it back. Recourse, on the other hand, in a recourse, candidates, the lender can foreclose the secured asset and also has recourse to the borrower himself, which means that the lender can collect the debt from the borrower's unsecured personal assets and from his future income. That's the difference between lien and recourse. 2 marks. I'll now move to answer part B, which I read. The shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of 15 million shillings available for investment. A financial analyst they hired to appraise some possible projects they can invest in has availed the following information. There's a column for project, then another column for initial outlay, there is a column for expected return, then a column for standard deviation. The projects are PQRS. PQRS are the projects, and the initial cash outlay 9 million, 7 million, 6 million, 8 million respectively. Expected return is 12%, 21%, 16%, and 14% respectively. Standard deviation 2.5%, 1.8%, 2.3%, 1.6% respectively. The covariances between various projects' contribution are as follows. Project pairing PQ, the covariance negative 3.1, PR 1.3, PS negative 4.1, QR 1.5, QS 1.7, RS 2 0.7. Additional information. Number 1, the management is planning to invest by pairing the projects. Number 2, the maximum capital that can be invested is the accumulated fund as shown above. Number 3, any paired project is mutually exclusive and none of the projects is divisible. Required for each possible project. Required, I repeat, required, Roman 1, for each possible project pair combination, calculate the expected return, correlation coefficient, and standard deviation. How many marks? 12 marks. Roman 2, advise the shareholders of Mali invested holdings on the optimal project pair based on the mean variance criterion. How many marks? 2 marks. Thus, question 3B, November 2020, Advanced Financial Management. We are going to take, first of all, question B, Roman 1. For each possible project pair combination, for each possible project pair combination, calculate expected return, calculate correlation coefficient, calculate standard deviation. First of all, candidates, we are going to we need to first of all get the possible project combination. Possible project combinations. Okay? The question does not give these project combinations. We are told that the management is planning to invest by pairing. And this company has a limit on capital as indicated in additional information number 2, that the maximum capital that can be invested is the accumulated fund. And the accumulated fund, we read in the first sentence that the accumulated fund of 15 million shillings is available for investment. So the company has 15 million shillings and the company can invest this money by pairing the projects. Like you can see project 1, which is project P, the initial cash outlay is 9 million. Project Q requires initial cash outlay of 7 million. That means project P and Q, combination of project P and Q is not possible because the total amount required to invest in project P and Q is 16 million, yet the maximum, the limit that the company has is 15 million. So project P and Q, combination project P and Q is not possible. But if you check project P and R, candidates, you can see project P requires 9 million, project R requires 6 million, which is equal to 16. 15 is equal to 15 million. Another combination is project P. There's no another combination with project P other than this R. The next one will be project Q and project R. Project Q and project R. The total initial cash outlay will be 7 million plus 6 million, which is equal to 13 million. Another combination is project Q and project S. The total initial cash outlay will be equal to 7 million, 8 million, 15 million. Then lastly, candidates, we can combine project R and project A. 6 million plus 8 million is equal to 14 million. That's the possible projects pair combination. Possible project pair combination. We have it right there. Now that's the starting point. It's on the basis of this possible project combination that we can now go ahead and calculate the expected return. The expected return. We'll first start with the expected return for the first possible project combination, PR. And to make our work easier, we will also calculate the correlation coefficient for project combination PR. We also calculate the standard deviation for project combination PR, and so on. So, what is the expected return for project combination PR? We'll have a small table here. First column is project. This project is PR, P and R. Then another column is the initial capital. Initial capital, project P, 9 million. Project R, 6 million. Then you'll have the weights. The weight is going to be 9 million plus 6 million, 15 million. The weight for project P will take 9 million divide 16 million. That will be the weight. 9 million divide 15 million. 0.6, that's the weight. Then 0.4, that's the weight for the second project. Then the other column is the expected return. We have expected return. Yes, in the question, expected return project P is 12%. Project R, expected return 16%. Therefore, candidates, another column is now the we are going to calculate, we are going to multiply the weight, this weight, by the expected return to get the expected return for project PR. Expected return for project PR. We multiply and then add. We multiply this weight, 0.6 times 12% plus 0.4 times 16%. We get the total there. That will be the answer for expected return for project P, combination PR. So candidates, we have 0.6 times 12, 7.2%. Then 0.4 times 0.16, 0.064. We'll add the 2 plus 7.2. This is equal to 7. Let me take it again. 0.4 times 16. This 6.4. 6.4 plus 7.2. 13.6% is the expected return. This is the expected return for project PR, combination project PR. Then the question required candidates to compute the correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Now the correlation coefficient, candidates, will be equal to the covariance of project PR divide the standard deviation of P times standard deviation of R. Covariance of PR, covariance of PR, which we have in that question, candidates. We have the covariance of PR. PR is 1.3. It's 1.3. The standard deviations are also given in the question. For project P, standard deviation project P is 2.5 times standard deviation for project R. R is 2.3. 2.3. That will be equal to 1.3 divided by 2.5 times 2.3. This is equal to 0.23. 0.23 is the correlation coefficient. Then we are required to compute the standard deviation. This is the standard deviation for the portfolio. We have the standard deviation for the individual projects. Here we'll compute the standard deviation for the portfolio. These are two projects. Standard deviation will be equal to, this is standard deviation for project PR, candidates. The formula is that this is equal to this square root. We're going to get the square root of weight of this, we're going to square the weight. We're going to square the weight of P, okay? Weight of P, then we square the standard deviation of P, okay? Square the weight of project P times the standard deviation of project P. Then we add the square of the standard, the square of project. We square the weight of project R, then we square we multiply. We are going to multiply the standard deviation, the square, this is just the variance, the variance of project R, all right, Then candidates, we add 2 times weight of project P times weight of project R, then we multiply by the covariance. This is the covariance of PR, So candidates, square the weight of P, square the weight of P, 0.6 squared times the square of the standard deviation of P, standard deviation P from the question, standard deviation 2.5 square plus 0.4 square times standard deviation R 2.3 square plus 2 times 0.4 times covariance of PR, covariance PR from the question, covariance PR 1.3. The rest is the work of the machine. We multiply 0.6 square times 2.5 square plus 0.4 square times 2.3 square plus 2 times 0.6 times 0.4 times 1.3. This is equal to, then I need to, before I need to get the square root 1.93. 1.93 is the standard deviation of the portfolio PR. We will do the same for combination QR. We will first calculate expected return. The expected return for combination QR. We'll have QR, this is the projects. Let me have columns, projects. Then we have initial investment. Then we have the weights. Then we have the expected return. Then we multiply the weight expected return. So project Q required initial investment of 7 million. Project R require initial investment of 6 million. Total 13 million. So the weight will be, is going to be 7 divided by 13. 7 divide 13, 0.5. Then 6 divide 13, 0.464. Expected return. The expected return from the question we have project Q 21%, project R 16%. Therefore, the expected return for this portfolio is going to be 0.54 times 21 plus 0.46 times 16%. 0.54 times 21, 11.34, 0.46 times 16, 7.36. We add 11.34 goes to 18.7%. This is the expected return of the portfolio QR. Then the next requirement is the correlation coefficient. Correlation coefficient QR. Correlation coefficient QR is equal to the covariance of QR over the standard deviation of Q times standard deviation of R. Okay. Covariance of QR provided in the question is 1.5. Standard deviation of Q 1.8 times standard deviation R 2.3. That's simple. 1.5 divide 1.8 times 2.3 is equal to 0.36. Then lastly, we are going to compute the standard deviation of the portfolio QR. Standard deviation of the portfolio QR, which will be determined by getting the square root of the weight, square the weight of Q times standard deviation of Q plus weight of R times standard deviation square of R. Then we are going to add 2 times the weight of Q times the weight of R. This is times the covariance QR. Covariance QR. This will be equal to the square root of 0.54 squared. Square the standard deviation 1.8 square plus 0.46 square times standard deviation of 2.3 squared plus 2 times 0.54 times 0.46 times the covariance of QR. The covariance of QR 1.5. That will be this is 0.54 times 0.54 squared, 4 squared times 1.8 square plus 0.46 square times 2.3 square plus 2 times 0.54 times 0.46 times 1.5. Then we get a square root. This is equal to 1.68. 1.68 is the standard deviation. We do the same for portfolio QS candidates. We'll begin with the expected return for portfolio QS. I need space. Let me use this space. Expected return portfolio QS. For portfolio QS, we begin with the project Q, project S. Project Q requires initial investment of 7 million. S required initial outlay of 8 million. 8 million. Total 15 million. The weights will be 7 divided by 15. 7 divide 15, 0.4. 8 divide 15, this is 5.3, this is 0.47. Those are the weights. Then we'll calculate we have the expected return given in the question for project Q. Expected return, project Q, 21%. Project S, expected return, 14%. So the expected return for the portfolio, QS will be 0.47 times 21 plus 0.53 times 14%. Okay, the expected return for the portfolio QS will be 0.47 times 21% plus 0.53 times 14%. 14%. Therefore, 0.47 times 21% is 9.87%. 0.53 times 14 is equal to 7.42% plus 9.87%, 17.29% is the expected return for the portfolio QS. Then we compute correlation coefficient for the same correlation coefficient for the portfolio QS. We know this is equal to the covariance of QS divided by the standard deviation of Q times standard deviation of S. Covariance of QS is provided, candidates, where it is written that the covariances between the various project combinations are as shown. Covariance for project QS, the second last, 1.7 divide standard deviation also given in the question for Q, 1.8 times the standard deviation is 1.6. Therefore, the correlation coefficient portfolio QS will be 1.7 divide 1.8 times 1.6. This is equal to 0.5. 0.59 is the correlation coefficient for the portfolio QS. The next requirement is the standard deviation of this combination or portfolio. The standard deviation of portfolio QS will be equal to the square root of the square of weight of Q times the square or the variance of Q plus the weight of the square of the weight of S times the standard deviation squared of this is S. Then we are going to add 2 times weight of Q times weight of S times the covariance of QS. Covariance of QS. So this is equal to, this will be equal to the weight, we have it, 0.47 squared. Standard deviation, we have it, 1.8 squared plus weight, 0.53 squared times standard deviation 1.6 squared plus 2 times 0.47 times 0.53 times covariance of QS, the covariance of QS 1.7. this will be 0.47 square times 1.8 square plus 0.53 square times 1.6 square plus 2 plus 2, this is times, okay, 2 times 0.53 times 0.47 times 1.7. Then we get a square root. The answer here is 1.51. 1.51 is the standard deviation of portfolio QS. A portfolio is an investment or is a combination of investments, a set of investment, a group of investment. This company had an option of investing in project Q and S combination. This is combination QS. So the standard deviation of this portfolio is 1.51. Then we will again compute the expected return for combination RS, project RS, combination RS, combination RS. Okay, so I'm going to have here the expected return for RS. So we'll begin with the project R and project S. Project R required the initial outlay of 6 million. Project S required initial outlay of 8 million. So we do the weights. This is 14 million. Therefore, the weight will be 6 divide 14 to get 0.42. Then we have 8 divide 14 to get 0.57. When we round off here, we have 3. Then there is the expected return for individual projects given in the question. For project R is 16%, project S 14%. Therefore, candidates, the expected return for the portfolio RS will be equal to 0.43 times 16% plus 0.57 times 14%. So 0.43 times 16%, 0.43 times 16% is equal to 6.88%. Then 0.57%, 5.7 weight times 14% is 7.98%. The total is 6.88 plus 7.98, total 14.86%. That is the expected return for the portfolio RS. Now, candidates, I'm going to rub here so that I can compute the correlation coefficient for the portfolio RS. Then I also compute the standard deviation for RS. But before I rub, candidates, I will need to have this somewhere. This is the expected return of the first combination. This one here, 13.6. I'll need this 13.6% in the second requirement, Roman 2, where we are told to advise the shareholders of Mali investment on the optimal project paired on the mean variance. To calculate the mean variance candidates, we divide standard deviation by the mean. In this case, the mean is the expected return of the portfolio. So I will rub here. Rub that. So candidate 13.6% is the, this 13.6% is the expected 13.6%. This is the expected return or portfolio, the first combination PR. First combination was PR. PR expected return, first combination PR. This is equal to 13.6%. I'll need that when computing the coefficient of variation, or the mean variance, Let's continue. We've done the expected return for portfolio RS. We are now going to compute the correlation coefficient RS, project RS. That will be equal to the covariance of RS divide the standard deviation of R times standard deviation of S. Covariance of project RS, portfolio RS, covariance RS 2.7 divide the standard deviation of R 2.3 times 1.6 times 1.6. So candidates, that will be the correlation coefficient, which is equal to 2.7 divide 2.3 times 1.6. This is equal to 0.73. Then lastly, standard deviation of the portfolio RS is equal to the square root of W squared R, standard deviation squared R, plus W squared S times standard deviation squared S, plus 2 into W R times W S, okay, times covariance RS. Covariance RS, this is equal to the weight, we have it 0.43 squared. The standard deviation, we have it 2.3 squared, plus weight 0.57 squared, standard deviation 1.6 squared, plus 2 weight 0.43 times weight 0.57 times covariance, we have it 2.7. The rest is the work of the machine, the calculator. 0.43 square times 2.3 square plus 0.57 square times 1.6 square plus 2 times 0.43 times 0.57 57 times 2.7. Then we get the square root. The answer is 1.77. That's the standard deviation. Candidates, we've answered Roman 1, which read, for each possible project pair combination, calculate the expected return, number 1. Number 2, correlation coefficient. Number 3, standard deviation. That's what we've been doing for each project combination. For example, the project combination for QS, we've done the correlation coefficient. We've done the expected, firstly the expected return. We did the expected return, then we've done the correlation coefficient, we've calculated the standard deviation for the portfolio, we've QS, that is QS, candidates, that is QS. For each project we have done the expected return, correlation coefficient, and standard deviation. For project RS, we've calculated the expected return, we've calculated the correlation coefficient, we've calculated the standard deviation. We did the same for project PR, we did the same for project QR. So we are going to move to answer the second part of this question. Advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance. Based on the mean variance. The mean variance is also known as the coefficient of variation. So I'm going to rub this bit, but maintain. I'm going to maintain. This is QR. This one here is the expected return QR. We want to calculate the coefficient of variation or the mean variance. How to calculate the mean variance? Mean variance, candidates, mean variance is equal to the standard deviation over mean. So mean variance is equal to standard deviation divided by the mean. In our case, the mean is the expected return. The expected return is the mean. We have done the standard deviation for each portfolio, all right? For each combination of projects, we've calculated the expected return for each portfolio. So we want to determine the mean variance for each portfolio. And this one here, candidates, 18.7% is the expected return for QR. 18.7%. I'm writing it down there because I want to use this space. So I have combinations. Then I'll have the first combination is PR. We are going to calculate the mean variance for PR, and I've said it is equal to mean divided by, the standard deviation divided by the mean. The standard deviation for PR, we calculated it 1.93. We divide the expected return for combination PR. Expected return here is 13.6. The next combination is combination QR. combination QR, the standard deviation QR is 1, we calculated it 1.68 divided by the expected return QR 18.7. Then the next combination is combination QS, the standard deviation combination QS is 1.51, QS 1.51 divided by the expected return QS is QS, we calculated it, QS expected return, QS here is 17.29. Then lastly, combination RS, the standard deviation combination RS, we have it here, 1.77 divide the expected return RS, 14.86. These are the possible combinations and the mean variances. So begin with the PR 1.93 divide 13.6 is equal to 0.14. When converted into percentage, this is 14%. Next is 8 point, this is 0.089. Next, 1.51 divided by 17.29, 1.51 divide 17.29, 0.087. Then lastly, RS 1.77 divide 14.86, 0.119. Now when converted into percentages, this is 8.9%, this is equal to 8.7%, is equal to 11.9%. So those are the mean variances. These are the mean variances. Then based on these mean variances, we are to advise this company. The question reads, advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion. Now, the most ideal combination or optimal project pair, advise the most ideal project pair, as you can see, candidates is QS, and why? Because it has the least mean variance or coefficient of variation of 8.7%. That means the project the risk is lower risk. It has a lower risk. Okay, 8.7. 8.7%. So we've answered that question, candidates, and I hope you take time to go through it. I hope you've also seen that the question is simple to the extent that candidates required to just have the formula. If you have the formula for these requirements, like the correlation of coefficient, then you put down the formula, then check from the question if the inputs are provided in the question. Like candidates, you see correlation of coefficient is equal to the covariance of RS. The covariance of RS is given in the question. The standard deviation is also given in the question. That would earn you marks. All right. And before calculation of the relation of coefficients, it was important in this question for the candidate to first of all identify the possible project combination. Because we read in the question that this company had a limit of 15 million shillings to invest in various projects that we were provided the initial capital outlay. So it needed simple mathematics, like in project P. Project P required 9 million, project Q required 7 million. So combination of P and Q was not possible because 7 million plus 7 million, 9 million plus 7 million exceeds the limit of 15 million. That's why we didn't have that combination in our working. So you see, that was the initial starting point. First of all, identify the possible projects combination. And this is what now guided the student on how to calculate these other aspects, the correlation coefficient, the expected return, the standard deviation. So it's important, candidates, you practice. Look at these questions are just the same, but they are varied slightly. So if you get the concept, then it becomes easier for you to answer any question that may be tested in the exams. Thank you for attending today's revision session. In our next session, we are going to answer question number 4 that was tested in November 2020. Then we will again answer question 5. We are dedicated to providing all solutions for the CPA students appearing in the Advanced Financial Management paper. Thank you. God bless you. Bye-bye.
Welcome to Manifested Publishers. My name is Mr. Dongo, a PFT, Public Finance and Taxation lecturer. Today, we will be going through August 2024 paper. And we start with question 1. Question 1A, explain the following terms used in public finance management. 1 is the consolidated fund services, and 2 is what we call division of revenue bill. So we come, put the question. So question 1, so A, explain the following terms. Explain the following terms as used in public finance management. As used in the public finance management. So 1 is what A is consolidated, what we call consolidated fund services. So basically, when you talk about a consolidated fund, that all government revenue are basically kept in account called a consolidated fund, except the ones that are not approved by the Act of the Parliament. So basically, when you say consolidated fund services, we basically mean we say services. Services means the expenses. We say the expenses means the expenses of which is charged. The expenses of which is charged directly. We say directly against. We say directly against the against, and you say and payable from the consolidated fund, from the consolidated we say the consolidated fund, we say under the virtue, we call it under the virtue of the Constitution, under the virtue of the Constitution, or any act, we say any act of the Parliament, any act of the Parliament, other than, we say other than appropriation, other than the appropriation. So that is what we call consolidated fund services. So services basically means expenses which is charged directly against and payable from the consolidated fund under the virtue of the Constitution or any act of Parliament other than the appropriation. So then we have the second, what we call division of revenue bill. Division of revenue bill. When you talk about division of the revenue bill, we're basically talking about how revenue is divided at the two levels of government. That is the national government and the county government. So this refers to it's a bill that aim at. It's a bill, we say it's a bill that aims at equitable, what do you call equitable allocation of funds between two allocations to distribution of funds between two levels of the government, equitable allocation, or equitable, just say the word distribution, equitable distribution of funds between two levels of government, i.e. national and county government. National and the county government. So when you talk about division of the revenue bill, we are basically talking about how revenue is equitably distributed of funds between two levels of government. That is basically the national government and the county government. The national government and the county government. That is how basically we tackle that question 1A. We'll pick it on the next question. We say outline 5 purposes for which national government should borrow money according to the provisions of section 192 of the Public Finance Management Regulation 2015. So we put it down. That is B, question 1B. We say outline 5 purposes. Outline 5 purposes for which the national national government, for which the national government should borrow money, for which the national government should borrow money according to the provisions, of section 192, we say of the public financial management regulation. We call it Regulation 2015. So basically, we are being asked by the examiner the 5 purposes to which national government should borrow money according to the provision of the section 192 of the Public Financial Management Regulation of the Public Financial Regulation of 2015. So basically, national government would borrow money for various purposes. One of it is to overcome budget deficit. One of the very common things about these developing countries, Kenya being one of it altogether, that is majority of the budget, most of the budget cannot be covered by the revenue. So one of the reasons is that they borrow to overcome a deficit. We also have another reason that we can talk about in case of emergency, so we can put them down. We have one, what we call financing the national, what we call the national deficit, financing what we call the national deficit when expected expenditure is more than the expected revenue. The second is borrowing for the purpose, what we call borrowing for the purpose of the cash management, borrowing for the purpose of the cash management, borrowing for the purpose of the cash management, borrowing for the purpose of the cash management. Then we talk about honoring. Sometimes you find that the national government would borrow to pay back loans that are due. So we say honoring, what we call honoring, obligations, honoring obligations under outstanding, what we call outstanding, under outstanding national government, honoring obligations under outstanding national government guarantees. Then we can talk about the next, what we call refinancing, what we call outstanding debt, refinancing what we call outstanding debt, or repaying, what we call repaying a loan, or repaying a loan to its date of repayment. Refinancing outstanding debt or repaying a loan to its dates of repayment. So they can also borrow. We can talk about lastly borrow in case of emergencies. They can decide to borrow in case of emergency. These are basically unforeseen events. So basically, this is the reasons that the national government will probably borrow in relation to the provisions of Section 192 of the Financial Management Regulation 2015. That is how we basically tackle that question. We'll pick it on the next question. We're being told Section 194 of the Public Finance Management Act of 2012 specify the functions undertaken by the Public Sector Accounting Standards Board, that is PSSB, Public Sector Accounting Standards Board. So with reference to the above statement, describe 6 functions. Describe 6 functions. We put it down on the board. So that is C. So we talk about section, we say section 194, section 194 of public, what do you call the public financial, of the public financial management, public financial management of the Public Financial Management Act, Act 2012, of the Public Financial Management Act of 2012, we say, comma, specifies to be undertaken, we say to be undertaken by public sector, by the public sector, what do you call the public sector accounting, public sector accounting standards board, public sector's accounting standards board, into bracket, that is the PSSB, public sector's accounting standards board. So then you say, with reference to the above statement, with the reference to the above statement, with a reference to the above statement, describe, we say describe functions of PSSB. Describe the functions of the PSSB, Public Sector Accounting Standards Board. So number 1 is to define, to understand what you mean by Public Standard Accounting Standard Boards. It's basically the role. We need to understand that this basically comes from topic 3, that is oversight of the public finance. One public sector accounting standard board is one of the areas of oversight. One of the areas of oversight. That is basically one of the areas of oversight when you look at the public sector accounting standards board. And basically, in going through these questions, in going through this particular question, it's very important that one of the roles of this public sector accounting standards board is basically to set what you call accepted accounting and financial standards. One of it as a role in the bid for oversight, we call it set. We say set. Generally, what do you call generally? Accepted. Set what you call generally accepted. Set what you call generally accepted. Accounting and financial standards. The word is to set. The word is to set. Implementation is not the role, but basically is to set generally accepted accounting and the financial standards. The next we can talk about prescribing an audit procedure which basically comply with the PFM, what is the Public Financial Management Act. We say prescribe, internal audit procedures, internal audit procedure, basically to prescribe internal audit procedure, which comply with PFM Act. So basically, it prescribes internal audit that basically will comply with what you call Public Financial Management Act. So we can proceed to the next. That is the third point on that. We say that they set this standard. They don't implement, but basically they set the standard. So the next we can talk about prescribe the minimum standard. What you call prescribe the minimum. We say the minimum. What you call the minimum standard. What you call the minimum standard. Prescribe the minimum standard of what you call maintenance, minimum standard of maintenance of what you call proper books of account, of maintenance of proper books of account, minimum standards of maintenance of the proper books of account as the next role. Remember, they do the oversight role. And four, we can talk about what you call publish. What you call publish and publicize. Publish and publicize. Publish and basically publicize. And you say publicize the accounting. What do you call the accounting? The accounting and financial standards and the financial, what do you call the financial standards and the financial standards. Publish and publicize the accounting and the financial standards and any directives and any, what do you call, any directives, directive and directives and guidelines and the guidelines prescribed by the board. Prescribed by the board. What do you call prescribed by the board? So basically, publish and publicize the accounting and the financial standards and any other directive that is basically prescribed by the board. So we have the next, perform. We can say that is 5, that you say perform any other function. Perform any other function. Function, we say function related. Any other function related to advancing. What do you call advancing? Related to advancing. Prescribe any other function related to advancing. Financial, taking it higher. Financial and accounting. We say financial and accounting. Perform. This is say perform. Perform. We just rub it and write it clearly. Perform. Any other function. This is say any other function related to advancing financial and accounting system. System management. And reporting in the public sector. And the reporting basically done in the public sector. So perform any other function related to what you call advancing financial and accounting system management and reporting in the public sector. And lastly, we say in consultation. We say in consultation with the cabinet, secretary. In consultation with the cabinet secretary on the effective, what do you call effective, on the effective dates of the implementation, in consultation with the Cabinet Secretary on the effective dates, that is Cabinet Secretary of Finance, on the effective dates of implementation of the standards, We have not said they implement, but they consult on the effective dates of the implementation of the standards, and you say, comma, gazette, the dates, we say gazette the dates, for application, gazette the dates for the application of standards, and guideline. Again, very important for us to get to understand that when you talk about public sector accounting standard board, that's an oversight. So there are also various levels of oversight, that we basically have in relation to oversight. Also, various areas of oversight, apart from the public standards accounting boards. We have the internal audit as also an oversight. That's an area that can also be examined. So as you look at this, it's also very important to look at other levels of oversight. And I've talked about one as internal audit. And what is the role of internal audit? That is how we basically tackle that very question. We'll pick it up on the next question. That is question 1, Roman D, the last question on 1. So the question says, in relation to the public procurement and asset disposal regulation 2020, outline 5 methods that accounting officer or procuring entity or procuring entity may use to dispose the asset. So we have the question on the board. We say that is D. We say in relation to the public, what do you call the public? In relation to the public procurement, in relation to the public procurement and asset disposal, regulation 2020, regulation 2020, outline 5, we say outline 5 methods, that an accounting officer can, we say, use 5 methods that accounting officer can use, that an accounting officer of we say of a procuring entity may use to procure, may use to dispose asset. May use to dispose asset. So when you talk about disposal, is how we do away with the asset. And when you look at this topic, that is basically topic 4 on procurement. So we are basically being asked that in relation to what you call the public procurement and disposal regulation, that is of 2020, what are the methods that that accounting officer of a procuring entity may use to dispose? To dispose basically is to do away with the asset. What are some of the methods that would basically be used to do away with the asset? One is, we call it a trade-in. what you call trade-in. You know, you can have a new asset and you do away with the older asset. We call it trade-in. That is the first method that we dispose of an asset. So we move to the next. We move to the next. As we wrap this to the end. As we wrap this at the end. As we wrap this to the end. As we wrap this to the end. The next method that a procuring accounting officer of a procuring entity can use to dispose an asset, can basically use to dispose an asset. We talk about sell by public, what you call sell by public tender, what you call sell by public tender, as another method that can be used to dispose an asset. Then you can also call number 3, what you call sell. We say sell by public auction. What do you call the public auction? Sell by what you call public auction. Sell by the public auction. We also have what you call transfer. Another way for disposal, we say transfer. We can call it transfer to another, what do you call another public entity. Transfer to another public entity, or part, what do you call part of public entity, part of the public entity, with or without financial adjustments, with or without financial adjustment, with or without financial adjustment. We've talked about transferring to another public entity or part of public entity with or without what you call a financial adjustment. And lastly, what you call waste disposal management. What you call waste disposal management. Lastly, what you call waste disposal management. Waste disposal management. Very important for learners to understand that this is also a very crucial topic in the public finance. We need to understand even the role of IFMIS under this, the roles of a number of things. For example, IFMIS in relation to procurement. What are the benefits of electronic procurement as opposed to a procurement that was basically being done physically? What is the role? Pre-qualification of tender. What are some of the pre-qualifications that are required for tender, for the ones that are basically picked for tenders, basically still touching on procurement. But particularly for this, we were basically talking about a number of ways that an accounting officer in a procure entity may dispose an asset. We've talked about trade-in. We've also talked about sell by public tender. We've talked about sell by public auction, transfer to another public entity or part of public entity with or without financial adjustment. And lastly, we've talked about what we call waste disposal management. That is how we particularly handle that last question. And that marks the end of the question 1. See you in the next class.
Welcome to Manifested Publishers. My names are Mr. Bernard Mariga. We can start with a question in August of 2022. Let us start with a question in August 2022. 2022, question 3B. August 2022, question 3B is a question I want us to deal with. Question 3B of August 2022. And this question states, a hotel with 50 single rooms is recording 80% occupancy in a normal season of 8 months and 50% occupancy in off-season of 4 months in a year. The following information is provided. You have annual fixed expenses, staff salaries excluding room attendants of 7.5, repairs and maintenance of 2.6 million, depreciation on buildings and furniture of 2.4 million, other fixed expenses like dusting and sweeping is 3.25 million. So that your total fixed cost is 15,750. Variable expenses per guest per day. Linen and laundry is 300. Electricity and other facilities 200. Miscellaneous expenses 250. Then the management wishes to realize a profit of 25% on total cost. 25% on total cost. Required. Number 1, the required tariff rate per room. Number 2, the break-even occupancy in normal season, assuming 50% occupancy in off-season. Number 3, the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season, respectively. Advice on the appropriateness or otherwise of the above proposal. So let's analyze what we have been given in this question. One of the items you have been given is the fixed costs. And your fixed cost in total is how much? 15,750,000. 15,750,000. Then you also have another cost that is known as a variable cost. And a variable cost, remember, is a cost that increases with output. It also decreases with output. A good example of a variable cost is direct material, direct labor, direct expenses. Variable overheads should also be added to those costs I have mentioned above to determine your variable costs. So your variable cost here, they have said there is a linen and laundry of 300 plus electricity and other facilities of 200 plus miscellaneous expenses of 200 and what? 50. Of 250. So that 300 plus 200 plus 250, 300 plus 200 plus 250 should be 700 and what? 50. 750. Then we can then answer, go back to what we require, what the question is asking. They want the required tariff rate per who? Per room. The required tariff rate per who? Per room. So the required tariff rate per room. So in this question, what they are simply asking you to do is to determine your selling price P. That is what they want you to determine. That is what they want you to determine, okay? Or your revenues, So we are going to take our annual fixed costs. We are going to take our revenues as your fixed costs plus your variable costs. Let me say fixed costs. Let me just write it in full. Fixed costs plus variable costs plus your profit. So your sales revenue is simply the costs. Remember, these are the costs, total costs, plus your profit, okay? We already have the fixed costs, which we have seen as 15,750. The variable cost here is 750, but it is per who? Per guest per day. So we need to determine our total variable costs. Our total variable costs. How do you do that? You determine your total variable cost by taking the variable cost per unit, you multiply that by your units. And in this case, you want to multiply that by the number of guests you have in an organization, in this organization. So let's determine the number of guests you have, where Q, in this case, is your number of who? Guests. Q is your number of who? Guests. Let's determine the number of guests. The first paragraph, they're saying, a hotel with 50 single rooms is recording 80% occupancy in normal season of 8 months and 50% occupancy in off-season of how many months? 4 months in a year. Then assume a 30-day month in all cases. So let's determine, we write there, determination of the number of guests. Or the occupancy. We are going to take that by taking during peak season, you had 80% occupancy. You multiply that by the 50 rooms that organization has. They are occupied for how many months? 8 months. 8 months. Then you multiply by the number of days. Number of days, that is during peak season. Plus, you also do the same for what? Off-peak season. And how will you do that? You're going to take 50% occupancy. The rooms that are being occupied are 50 rooms. The off-peak season lasts for 4 months. For 4 months. But each month has how many days? 30 days. 30 days. So let's identify the occupancy level. Let's identify the occupancy level. During peak season, you expect 9,600 as the number of what? Guests that will occupy that. Then during off-peak, you expect 3,000 guests. So that in total, you're going to have how many guests? 12,600 guests. You're going to have 12,600 what? Guests. The reason we are determining the number of guests, remember, is so that we can be able to determine our total variable costs, which will be the product of a variable cost per unit that already we have of 750. Then by the number of units, which are your guests, which are how much? 12,600. So therefore, your total variable costs will be your variable cost per unit of 750. You multiply by 12,600. 750 times 12,600. So therefore, your total variable cost is 9.4 million. 9.45 million. Once we have determined our variable cost, we then will add our fixed cost to determine our total costs. Then our what? Profit. So let's come here and say that your total fixed costs, your total fixed cost is how much? 750,000 plus your variable cost will give you your total costs. And how much is your total cost in this case, class? $25,200,000. That is your total what? Costs. But remember, to get our revenue, we simply take our total cost plus our what? Profit. So then we need to add our profit. we need to add our profit. And they were saying that profit is 25% on what? Cost. So this is known as profit markup. So you're going to say 25% of 25, 200 what? 1,000. That will give you 6.3 million. 6.3 million. So to get our revenue, you then add, which is 31,500 what? 1,000. 31,500,000. You refer to that as your total revenue. As your total revenue. When we have our total revenue, we can now determine our what? Selling price per unit. We can determine our selling price per who? Per unit. So let me do away with this. You know that to get your revenue, you simply take your selling price per unit, you multiply by your units. Therefore, our revenue or our revenue can be used to determine your what? Selling price per unit by simply taking your total revenue, you divide by what? Your units. Your total revenue is how much? 31,500,000 divide by 31,500,000 divide by your total number of what? Guests. In this case, we are dealing with a hotel, so we normally have got what? Guests. So therefore, divide by the total number of guests, which are 12,600. So please confirm that that is 2,500 per who? Per guests. 2,500 per who? Per guests. So each guest will be charged how much? 2,500. So that's the first part of that question. The required tariff rate per who? Per room, eh? All right. Then note number 2. Note, and that should be per room. Note number 2. The break, or rather, required note 2. The break-even occupancy in normal sales, assuming occupancy is 50% of season. Eh? So the break-even point. Break-even point. All right. So we can have this in what? In units, which in this case is in your what? Guests. Your guests are the measure of what the company is producing. Eh? To determine your break-even point in units, you simply take your fixed costs, divide by your contribution margin. Divide by your contribution margin. Your contribution margin, we've said, is the difference between your selling price and your variable cost per unit. Your selling price, we've just determined it as 2,500. Your variable cost per unit was 750. So therefore, to determine the contribution margin from the above, you will take 2,500 divided by minus 750 to get a contribution margin of 1,750. So your break-even point in units will be a fixed cost. Your fixed cost was 750,000 divide by 1,750. Divide by 1,750. So for that organization to be able to cover its cost, they need to have to occupy 99 rooms or what? Guests. Right. In shillings, what sometimes they refer to as break-even point revenue, shillings, or sales. If you see break-even point revenue or sales, it basically means break-even point in what? Shillings. It is determined by taking your fixed cost, divide by contribution margin sales ratio. Divide by contribution margin sales ratio. Your contribution margin sales ratio is given by contribution margin divided by selling price. Contribution margin divided by selling price. Your contribution margin is 1750 with a selling price of 2500. With a selling price of 2500. So your contribution margin sales ratio is 0.7. So therefore, your break-even point will be 15,750,000 divided by 0.7. Divide by 0.7. So for that company to be able to break even, they need to sell 22,500,000. They need to sell 22,500,000, which could also be obtained by taking your break-even points in units, you multiply by your selling price. You multiply by your selling price. So these two answers should be the same. Those two answers, indeed, they are the same. So those two answers, indeed, they are what? The same. All right. Part 3 of that question. Part 3 of that question. They are saying the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season respectively. Advice on the proposal above. So part 3. Decrease selling price by what? By 20%. Decrease the selling price by 20%. Now, to analyze this question, to analyze this particular question, there are two ways we can do that. Number one, we can determine the profits of that company after they have dropped the selling price by 20%. Number two, we can determine the contribution as a result of dropping the what? The selling price by 20%. Once we have done that, we then compare with our current what? Selling price. So when you're making decisions here, you normally make decisions considering by taking the contribution or the profit. The contribution or the what? Profit. So let me see. Let us do this together. Let's do this together. Your new selling price P, the decrease by 20%, it means your new selling price will be 80% of the current selling price, and the current selling price is what? 2,500. So that's your new selling price. The variable cost is not changing. It is still going to be 750, which is 300 plus who? 200 plus 250 to give you how much? 750. So that now your contribution margin will be 2,000 minus what? 750. It will be 1250. 1250. Your contribution margin sales ratio Your contribution margin sales ratio is your contribution margin divided by what? Divide by P. 1250 divide by 0.625. That is your new what? Contribution margin sales ratio. To determine your profit, you know, you simply take your contribution margin, you multiply by your units minus your fixed costs. Alternatively, you can take your contribution margin sales ratio, you multiply by your revenue in shillings minus your who? Fixed cost, minus your revenue times your revenue minus your fixed cost. Let's determine the units as a result of what? The drop in what? Selling price. They're saying that if you decrease the selling price by 20%, you're going to improve occupancy at 100% and 70% in the normal what? Season. So we need to get our new the number of guests that are going to occupy that. So you're going to say it is 50 what? Rooms that are being occupied what percent? 100%. They are being occupied for how many months? 8 months during peak season. And you know each month is having how many days? 30 days plus there are 50 rooms that will be occupied 70% of the time. The occupancy during off-peak is how many months? 4 months. Then per day is how much? 30 days. 30 days. So this means that is 1200 guests. That is 4200 guests. Right, so that the total here will be 16200 who? Guests. So when the company reduces the selling price by what? By 20%, your occupancy will increase or will come to what? 16200. Let's get now the profit. Let's get the profit. You're going to say your profit here is your contribution margin. Your contribution margin was 1250. You multiply by how many guests? 16,200 minus a fixed cost of 15,750,000 or 15,750. So therefore, your profit should be 4,500,000. Now, then let's advise them. Remember, they are saying we advise them. We want to advise them on whether they should drop the selling price by 20% or they should continue selling and continue with the selling price of how much? 2,500. Now, when your selling price is how much? 2,500. Your profit is how much? Your profit in shillings and your selling price is 2,500. Your profit is 6,300. 6.3 million. When you drop your selling price by 20% to how much? To 2,000. Your profit is how much? 4,500,000. 4.5 million. So there is a decline in profit by what? By 1,800 or 1.8 million. So therefore, what will you advise them? You're going to tell them to continue with selling price of how much? Of 2,500. Why is that so? Because the profits have dropped to 4,500 when you have done what? When you have dropped your selling price with an intention of increasing your occupancy. So kindly Tell that organization not to drop its what? Selling price. Not to drop its selling price. All right. Now that we have understood a single product, CVP, in your own free time, you can look at April 2023, question 4C.
Part B of the question reads as follows. S and M are advocates operating under the name SM Advocates. The firm's trial balance for the year ended 30th June 2022 is as shown below. They are talking of costs charged to clients through to capital. Of course, the trial balance has been given and it is balancing at 1,518,000 and also 1,518,000. Additional information. It's estimated that debts amounting to 16,500 are uncollectible and should be written off. Depreciation, that is number 2, depreciation should be provided at the rate of 20% per annum on the book value of the furniture, fittings, and library books. The uncompleted work on 30th June 2022 was valued at 70,500,000. Required statement of profit or loss for the year ended 30th June 2022 and the statement of financial position as at 30th June 2022. So this question was under preparation of financial statements from other entities, and more specifically it's about professional firms, and this is a firm for advocates. So we'll go straight to the first part of the required, that is Roman 1. SM Advocates. SM Advocates. Statement of profit or loss. Statement of profit or loss. Statement of profit or loss for the year ended. For the year ended 30th June. For the year ended 30th June 2022. Great. So shillings. Cost charged to clients. Cost charged to client, that is the same as professional fees. So we are going to use as it is. Costs charged to clients. Costs charged to clients. Same as professional fees, 750,000. 750,000. Add work in progress. Work in progress. Work in progress carried down. A work in progress carried down is the same as additional information number 3. And completed work, that is 7,500. 7,500 less work in progress brought down. Work in progress brought down is the same as the work in progress balance brought down on the trial balance, 110,400. So this one is going to be deducted. So that is 750,000 plus 7,500 minus 110,400, 710,100. 100. That is like total income total professional fees for that period less expenses The first expense is office expenses. The office expenses amounted to 25,500. 25,500. Postage, telephone and internet. Postage, telephone and internet. So postage, telephone and internet amounted to 54,600. 54,600. Printing and stationery. Printing and stationery amounted to 105,000. Printing and stationery. Rent and rates. Rent and rates 180,000. That has been given us 180,000. Salaries to staff. Salaries to staff 216,000. Salaries to staff is 216,000. And finally, the expenses on the trial balance have been exhausted. We move to the additional information number 1. There is irrecoverable debts. Irrecoverable debts amounted to 16,500. And finally, depreciation, which is being provided on furniture and fittings, and depreciation is at the rate of 20% per annum on book value. 20% per annum on book value. So we have the figure of furniture, which is of course at book value. So that is 20% times the value of furniture is 135,000. 135,000. That will give us 135,000 times 20%, 27,000. 27,000. Once you have the expenses there, it is 25,500 plus 54,600 plus 105,000 plus 180,000 plus 216,000 plus 16,500 plus 27,000. This is 624,600. 624,600. And profit for the year. Profit for the year. The profit for the year is 710,100 minus the answer 85,500. 85,500. So that was the statement of profit or loss for that professional firm during that particular period. That takes us to the statement of financial position. SM Advocates. SM Advocates. Statement of financial position. Financial position as at 30th June. 30th June 2022. As at 30th June 2022. So we have assets, or before assets, we can bring in the two columns. And non-current assets. Under non-current assets, we have furniture, fittings, and library books. Furniture, fittings, and library books. Furniture, fitting, and library books. Now let us compute the book value for the same. The cost is 135,000. Remember, the cost was 135,000 minus depreciation, which we've computed as 27 minus 27,000. That is the depreciation that we even computed in the statement of profit or loss. The book value is 108,000. 108,000, and that is the only non-current assets. Current assets. Current assets. We have the first one being work in progress, carried down, work in progress at the end of the year. The work in progress at the end of the year, in additional information number 3, was 7,500. We have receivables. Receivables amounted to 234,000. 234,000. Cash at bank. Cash at bank. Or before we record cash at bank, receivables is to be affected because there was irrecoverable debts. There was some irrecoverable debts, so this one is going to be reduced. So that is 234,000 minus the recoverable debts of 16,500. 16,500. So that is 234,000 minus 16,500, 217,500. 217,500. Then there is cash at bank divided into 2. There is client and there is office account. Client account and office account. Client account is 74,400. Office account is 167,100. 167,100. Any other current asset here? We have disbursement on behalf of clients. 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 36,000. 36,000. Disbursement on behalf of clients. 36,000. So the total assets. Total current assets 7,500 plus 217,500 plus 74,400 plus 167,100 plus 36,000 565,500 565,500 565,500. Total assets. Total assets plus 108,000 673,500 673,500. From that point we move to capital and liabilities. Capital and liabilities, and we have capital. The capital account stood at a balance of 612,000. add profit for the year. The profit for the year was 85,500 less drawings. Drawings amounted to 180,000. Drawings amounted to 180,000 and they are to be subtracted. So that is 612,000 plus 85,500 minus 180,000, 517,500. Non-current liabilities. Non-current liabilities, and non-current liabilities were not there, so it's going to be nil. Current liabilities were given as follows. We have clients for monies held on their behalf. So clients for monies, held, of course, on their behalf, for monies held on their behalf, amounted to 74,400. Creditors, 81,600. Creditors, 81,600. Total is 74,400 plus 81,600, 156,000, which gives us the total capital and liabilities. Total capital and liabilities, which is 517,500 plus 156,000, you get 673,500. 673,500. So, learners, that is how the question was supposed to be handled. That is for financial reporting August 2022 question 4, which combined lease accounting IFRS 16 and also professional firms in financial statement of other entities, and more specifically professional firms. See you again in our other subsequent revisions. My name is Nicholas Sikali.
Now, you can look at a similar question, the previous question. You can look at a previous question. It has been tested just a few semesters back. Let's go to September 2021. September 2021. September 2021. Question who? 5B. September 2021. Question 5B. The question is saying the standard cost of certain chemical mixture is 40% material A at 20 per kg, 60% material B at 30 per kg. The standard loss of 10% is expected during production. During the month of July, the actual data was as follows. Material A used 90 kgs at a cost of 18 per kg. Material B used 110 kgs at a cost of 34. The weight produced was 182 kgs of good production. Let's start by getting our material mix, our material price variance. Our material price variance, you say it is your actual quantity, standard price minus actual price, Your actual quantity, you have two types of materials, A and who? B. The actual quantity you purchased was 90 kgs. The standard price per kg was 20 minus an actual price of 18. For material B, your actual quantity was 110. Standard price per kg was 30 and your actual price per kg was 34. 30 minus 34. This must be 180. That must be 400 and what? 40. The standard or the material price variance here for A, you had budgeted to buy at 20, but instead of buying at 20, you bought at what? 18. So that's good. So that is what? Favorable. B, you had budgeted to buy at 30, ended up buying at 34. So that is also what? That is adverse because you've spent an extra amount. Then you confirm what kind of variance this is, and this is 250, which is what? Adverse. 260, which is adverse. That is your material price variance. Let's get our material mix variance. And how do you get your material mix variance? You say it is your standard price, your actual quantity in standard mix minus your actual quantity in actual mix. Standard price, actual quantity in standard mix minus actual quantity in actual mix. And actual is standard price B. The standard price of A is 20, B is 30. Your actual quantity that was used is 90 for A and 110 for B. Your standard mix, the ratio of how you are using your materials is 40 is to 60. That is 200. That is 100. Therefore, actual quantity in standard mix. You simply share the actual quantity using the ratio of your standard mix. Using the ratio of your standard mix. And how will that be? This will be 40 over 100 times 200. 60 over 100 times 200. That is 80, and that is what? 120. All right. Your actual quantity in actual means we said, in actual mix we said is your actual quantity. So let's get your material mix variance here. Your standard price is 20. Actual quantity in standard mix is 80 minus an actual quantity of 90. 100. Standard price of 30. Actual quantity in standard mix of 120. Actual quantity in actual mix of 110. This will be adverse, favorable. So that in total, that will be 100 favorable. Okay. The next item they are asking us to determine is your material yield what? Variance. Material yield variance. You said, how do you get that? You simply take your standard material cost per unit into bracket your standard yield minus your actual yield. Standard yield minus actual yield. Let's determine our standard material cost per unit. They were saying there that the standard cost of material of a certain chemical, 40% of material B was bought at 20, 60% of material B was bought at 30. So therefore, your material cost per unit, you're going to take those percentages times the price of each. Which will be 26. That should give you 26. Let's determine our standard yield. Then now need to determine our standard yield. Now they were saying the standard cost of a certain chemical mixture is 40 and 60, and a standard loss of how much? 10% is expected during what? Production. Okay. So this is what we do here. We first identify the input materials that were introduced and the output that was done what? Produced. Okay. And here with an 100% input of materials, with an 100% input of materials, your output was 90%. Your output was what? 90%. Why? Because of a standard loss of 10%. 10%. Okay. If you introduce 200, this can ignore this percentage here, that way. If you introduce 200, how much should have been your standard yield there? Your standard yield should have been 180 units. If you are to use the material in the same way you are using according to what you budgeted, you should have produced 180 units. So your yield variance will be 26, 180 minus an actual yield of 182. Your actual yield is 182. This is 52, which we are going to say is what? This is an output. This is output. So yield means output. So we are going to say it is what? Favorable. Favorable. Okay. Your material usage variance, it's going to be your material mix variance plus your material yield variance plus your material yield variance. Your mix variance is 100 favorable. Your yield variance is 52 favorable. So that is 162 what? Favorable. Let's determine our material cost variance, which is your material price plus your material usage variance. Your price variance is 260 adverse plus 162 what? Favorable, which means that is 98 what? Adverse. 98 adverse. And that is how you determine your what? Your advanced variances of who? Of material. Those are the advanced variances of what? Material. All right. Now that we have understood the advanced variances of material, We also should look at the advanced variances of labor, the advanced variances of fixed overheads, and also the advanced variances of sales revenue. Okay, all right. I hope that has been clearly understood. That has been clearly understood. That has been clearly understood. Right. Now, when we meet in the next lesson, we will introduce the advanced variances of what? Labor. We will introduce the advanced variances of labor, which will be in the next lesson. So from me, you can attempt a question, to give you a question that you can attempt in your own free time. You can look at August 2022 question 5B as an assignment, just for your practice. Sorry, your assignment. Please look at this question for your own practice. August 2022 question 5B. Question 5B. There is a variance of what? It is an advanced variance of materials. All right. So allow me, and on behalf of the institution, or on behalf of Manifested Publishers, we can call it a day. See you next time when we will tackle labor variances and overhead variances and sales variances that are advanced in nature. So goodbye and God bless you. See you next time.
Hello learner, welcome to Manifested eLearning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the business and data analytics April 2023 question 22. It reads as follows: you work as a management accountant for Majani Limited, which deals in tea production and export. Before embarking on next year's budgeting, you are tasked with analyzing past revenue and price trends. As a starting point, your supervisor has provided you with historical price and production data as shown in the worksheet. So you can see the dates have been given to you, the production, millions of kilograms, prices per kilogram. We move down and see what we are required to do. A. Plot a line graph for price against time or dates. Insert a linear trend line displaying the equation and R squared on the chart. Briefly discuss your results. So we go back up here and pick the relevant data. We start with the dates, move down like so. Then we go back up again and pick the prices. But before we pick the prices, we need to press Control so that now it can jointly pick the dates and the prices at the same time. So you can see as I press Control. Then you hover around Insert, click on Insert. Then you come to Line Chart. This is what to say, the line chart. So you click on it. Then you proceed on to click whichever chart pleases you amongst this list of for line charts. So let me click on the first one. So as you click on the first one there, we just need to just be patient a bit so that now the output like so can actually come out. So what we do, we just place this where it's supposed to actually be, next to the solution, ladies and gentlemen, there. And moving like so would mean that we would be able just to place the data where it is actually supposed to be, which is right over here. So what are we told? We are told that we need then to plot the line graph. That's okay, we've done that. Insert a linear trend line displaying the equation and r squared. So we need to display the equation and r squared. R squared represents the coefficient of determination. Coefficient of determination assists the investment expert or the accountant to identify whether the regression is reliable. So we go back up here and we just right click on the graph. We add a trend line right here, and when we click on this like that, the trend line should be able to appear. As you can see, moving towards the right here, the trend line appears. We can then now display the equation. So you can see all of these inputs over here. There's either exponential, there's linear. Linear is what we've been told that we need to do. The trend name, we just say it is the linear price per kg, which is okay. Then we move ahead and say that we need to display the equation, which is there, we tick that. And then we also display the r squared over here. So we tick that. That's what we've been told by the examiner. And then we can close this part here, close it. And for a clearer picture, we can place the equation just above there like that. And then also what is going to appear is going to be the r squared. Now that's much clearer as compared to where it was initially placed right there. So this is our part A. We can then move ahead and try and identify what we've been asked for part B. For part B, we are told, using a suitable MS Excel function, show that the coefficients shown in the trend line in A above are in fact a result of a linear estimation between historical prices and time. So what we do is that there is what is called a leanest function over here. So we move this over here like this. Say this is part A. Like that. So we can put over here part B. And we now use the leanest function plus leanest. So what is leanest? We are saying that the leanest represents linear estimation in full, and this value returns the statistic as it's shown over here. It returns the statistics that describe a linear trend matching known data points by fitting a straight line using least squares method. So what we do is that we then now need to identify what our y value is. Our y value represents the prices per kg. So come over here and highlight everything there for known y's. That. And then we go back up. Our known x's. Our x's are influenced, are the what we call the independent variables. They are the ones that influence the y's, saying that the dates and the production in kgs, we highlight both of them together like so. And then clicking on this part over here called constant here, it represents a logical value. And we say true over here. True. That. And we say okay. So we are told that an unexpected error occurred. So we just click OK here, because we are saying that we are getting negative 0.74. And this is the formula for the linear estimation. So linear estimation right here. And we say leanest. Like so. Leanest. And we can be able to put it like so. And put it in form of maybe say perhaps maybe you can be able to just highlight maybe in a different color and maybe, you know, just for presentation purposes there. So you can put it like so. Then maybe you can proceed on to put it in form of a thick square outside there. So we expect that this 0.7412 should actually be the same as the value right over there from the equation. So moving on, we can then move on to part C. Part C, you can see that you know that prices are affected by production. Because of this, you would like to run a regression between price, production, and time. Use data analysis tool pack to run the regression analysis, interpret your results. Be sure to discuss the coefficients and the parameters. So what we do is that we run a regression, part C here. Like so. And then we pick the dependent and the independent variable. So the data analysis tool pack is under the data tab here. Click on data. Then on the far right, you can see data analysis. Click on data analysis. And then you search for regression right here. You can see regression is right there. Click OK. What is our Y input range? The prices. So we click the prices like so. And then our X input, click there. We go back up again and we can see that both the dates, this is a multiple linear regression, the dates and the production levels are the ones that influence prices. That. So if perhaps you would want the labels, be able to put in labels over there like that, and then we click OK. So we have this output. So you can copy this output right over here and place it as appropriate on question 22 right under part C here. Control V. And we are saying that we can be able to see these regression statistics, R squared, which represents coefficient of determination. The standard error has also been given. We also have number of observations, so 154. That. And here is what we have as the intercept right here. We have the intercepts right over here. Then we have the dates over here. So you can change this to dates. And here you can be able to say production, and millions per kgs production. Kgs. That. When x is 0, what is the value of y? Then that's what is represented by the intercept there. The dates are coefficients that influence the prices, the dates as well as the production in terms of kg. So we are saying that you can see this is the intercept and the date and the production per kg. That. Notice that under leanest over here, we expect negative 0.074. That. So 0.074 should be the part of the intercept right there. We can now move on and understand or analyze the p-values here. Come to home and we come like so, we do like so. We are saying that low p-values less than 0.05 means that the coefficient is likely not to equal 0. But if we have high p-values greater than 0.05, then we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. in terms of the F statistic over here, we need to look at the F statistic in collaboration with the P values. The F statistic, or rather, when you're saying that because the P values over here are greater than 0.05, with the exception of this production of kgs, then the model might not be reliable for analysis, or might not be used for analysis. When we look at the R squared, our R squared is given to us right over here. I can highlight that over there. And we're saying that we want our R squared. If R squared is greater than 0.95, then the regression should actually be reliable. In our case over here, it is not greater than 0.95, and hence the model is not reliable for analysis. It cannot be used to predict the future production levels. So what can we conclude from that analysis? We can conclude that the model is not good, because we are saying that the R squared is not greater than 0.95. Secondly, we are also saying that the P values right over here, because most of them are actually greater than, all of them are actually greater than 0.05, all of them 0.05, we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. We can also conclude that innovations can be, for example, to remove this constant value over here, to try and evaluate and estimate if the value is okay, or we can be able to use other metrics or other time series data to analyze or make inferences of this data that we're analyzing towards our left. So that is it for question 22. We hope that you have enjoyed it and you've understood how to run a regression. Thank you for being with Manifested Publishers. Be blessed.
Welcome to Manifested Publishers. My name is Mr. Dongo, Public Finance and Taxation Lecturer. Today we are going to handle public finance paper, that is August 2024, question 4. August 2024, question 4. August 2024, question 4. August 2024, question 4. So the first question, that is question A, explain the following terms as used in taxation. Explain the following terms as used in taxation. One is what you call duty drawback. Question 4A, Roman 1, is what you call duty drawback. What you call the duty drawback. So when you talk about duty drawback, we're saying means a refund. This basically means, we say means a refund, of all or part, or we say or part, refund of all or part of any import, duty paid in respect, we say in respect of goods, exported, in respect of goods exported, or used, we say used in a manner, or for the purpose, exported or used in a manner, or for purpose, purpose prescribed, we say prescribed, prescribed, purpose prescribed, prescribed as a condition, we say as a condition, for granting duty drawback, for granting duty drawback, for granting duty drawback. So very important we say that when you talk about duty drawback, we basically mean a refund of all or part of duty or part of any duty of any import duty paid in respect of goods exported or used in a manner or for the purpose prescribed as condition for granting duty drawback. So the keyword is refund of all or part of any import duty paid in respect to goods exported. So that is what you call a drawback. The second, that is A Roman 2, we have what you call sufferance, what you call sufferance WAF, what you call the sufferance WAF, what you call the sufferance WAF, sufferance WAF. So when you talk about sufferance work, it basically means any place, we say means any place, other than, any place other than, unapproved, what do you call unapproved, any place other than approved, place of loading, we say loading, or offloading, loading or unloading, or offloading or unloading, any other than approved. So it means a place other than approved, a place other than the approved. Approved basically means the one that is recognized for loading and unloading, at which we say at which a commissioner, may allow, we say at which a commissioner may allow any good to be loaded, or unloaded, to basically be loaded or unloaded. So then we have Roman 3. What you call import declaration fee. Import declaration fee. So when you talk about import declaration fee, this is basically paid to goods that are imported into the country, basically for home use. Goods that are imported into the country, basically for home use. So we can put it down and say that it is a fee. It is a fee on all goods imported into the country for home use. Into the country, basically for home use. So we know that the amount payable is about 3.5% of the goods that are imported. But the keyword is basically when you talk about import declaration fee, it is a fee that is paid on all goods imported into the country for home use. So we can pick the next question, that is B, a calculation question. That is on partnership. A calculation question on partnership, that is B. So the first thing we're being told that there is a worker in Baraka started a partnership business in the year 2022, sharing profit and losses in the ratio of 5:3. So we have two partners, that is worker, and we have Baraka, and Baraka. So worker and Baraka, the ratio is 5:3. Then this should be ratio of 8:5. then this should be 3 to 8. That is the sharing ratio. That is basically the sharing ratio. So we're being told that the following is the statement of profit or loss for partnership in the year ended December 2023. So we're looking at sales. We know that sales, that should be a taxable income. General bad debts recovery, that is a non-taxable income. We have anticipated foreign exchange gain. When you talk about anticipated, those are not realized, so that's also non-taxable income. We have capital gain on the sale of land. Again, that is a non-taxable income. That is a non-taxable income. Then you have insurance recovery on stolen vehicle. When you talk about insurance recovery, basically on a stolen vehicle, that is also basically what you call a non-taxable. That is what we also basically called a non-taxable income. Then release of liability. When you talk about release of liability, then that is a taxable income. Release of a liability is a taxable income. Then you have interest from Ulinzi Sacco. When you talk about interest from Ulinzi Sacco, that is an investment income. So that is a non-taxable income in relation to the business. And we know that interest from SACCOs, we call them qualifying interest, where we're saying that the 15% withholding tax is final, and therefore we do not subject them to further taxation. Then we proceed to the expenses part. When you talk about the expenses part, we have the purchases. We have purchases, which is an allowable deduction, allowable expense or allowable deduction. Then you have purchase of computers. We call purchase of computers as non-allowable. Purchase of fixed assets are not expenses in taxation, so that is a non-allowable expense. We have repairs expenses. When you talk about repairs expenses, those should be allowable expenses. We have legal and professional fee. So on the legal and professional fee, we basically say that legal and professional fee can be allowable, and at the same time it can be non-allowable. However, if an examiner brings a question on legal and professional fee and there's not an additional information, then that legal and professional fee should be allowable expense. The next is what we call rent and rates. Rent and rate, that should be allowable expense. Then interest expense, we say that interest on partners' capital, that is non-allowable. However, interest on loans borrowed, that should be allowable. So we can look at the additional information. General expense is allowable expense, provided there's no additional information saying something contrary. Motor vehicle expenses, that should also be allowable expenses, provided there's no additional information saying something contrary. Then we have the insurance, that should also be allowable expense, provided there's no additional information relating to anything. Then we have what we call welfare expenses. Welfare, basically, if you have welfare for employees, that should be allowable. Then we have audit and accounting fee. Audit and accounting fee, that should also be allowable expense. Then you have computer softwares and programs. That is a capital expenditure. So capital expenditure, those should be non-allowable expense. Then lastly, we have traveling expense, a figure of 64, that should be allowable expense. So if you look at the totals and we minus from the incomes, the accountant basically got a net loss of 2,750,000, and this needs to be adjusted as a tax person when now we talk about in terms of tax. So additional information, we have legal and professional fee. Total was 816. Out of that, there is a legal and professional fee, the first one, that is legal fee on defense against alleged breach of trade contract. When you have legal fee on defense against alleged breach of contract, those should be allowable. Those are allowable expenses. The next is legal fee on tax appeal. That is a non-allowable, so that needs to be added back. That is a non-allowable expense, which is in the P&L. We need to adjust it by adding it back. We have legal land conveyance fee. Land conveyance fee is also what we call non-allowable expense, so we need to add it back. Stamp duty is also non-allowable legal fee. We also need to add it back. Then negotiating a business loan. When we have legal costs that we incur to negotiate a business loan, that we also say that is also non-allowable legal cost. Then we have recovery of bad debts. Legal fee that relate to customers and debtors, that is allowable. That is an okay expense. Then we have signing a 100 years lease agreement. When you talk about lease agreements, renewal and signing of leases, if leases are below 99, then those ones should be allowable. However, if leases are above 99 years, like the one we have in this particular question that says 100 years, then that should be a non-allowable. Then we have purchase of private or partner's private vehicle. That is a private expenditure. So purchase of a partner's private vehicle as a legal cost, that should be non-allowable expense. Then the last one on the legal fee, we have what we call legal fee on renewal of patent. Renewal of patents, that should also be non-allowable expense. So done on additional information 1. So additional information 2, we have repairs expenses comprised of the following. The first expense that relates to repair, we have the purchase of furniture. When you talk about the purchase of furnitures, those should be non-allowable expense. When you talk about the purchase of furnitures, those ones should also be non-allowable expense. We have what called designing and partitioning of a new block. Designing and partitioning of a new block, that's also a capital expenditure, so that is a non-allowable expense. Then lastly, we have what we call repainting of the old office block. That should be allowable. So that one we don't adjust by adding back. So we move to the to additional information number 3. Additional information 3. So we are told that impairment, 1 is impairment of patent, general expense. Impairment of patent, that should be non-allowable expense. The impairment of patents, that should be non-allowable expense. Then we have provision for general bad debts. Provision for general bad debts, that's a non-allowable expense too. We add it back. Then we have drawing of goods by partners. Drawing of goods by partners, we know for sure that those are non-allowable expense. So additional information number 4, that gives us to our working 1. We can call it working 1. So on the working 1, we're being told that purchases and sales were inclusive of VAT at the rate of 16%. Taxes paid or taxes refunded. Taxes paid are not expenses. That one we need to understand. The taxes paid are not basically expenses. So tax paid are not expenses. Again, we need to understand that tax refunds or tax that are basically on incomes, those are non-allowable. And we need to adjust the taxes on sales by lessing, the taxes on expenses by adding back. So we say that purchase and sales were inclusive of VAT at the rate of 16%. So we have the first one, that is purchase. Purchase, the figure for the purchase is 3,706,000 was inclusive of VAT. So that implies that this was 116%. So what is the VAT that we need to add back that were on purchases that understated the profit? Remember the VAT, we say VAT on purchases understates the profit. So correction is correction, add back. So we get that VAT. So say 16 over 116 times 3,706,000. 3,706,000. If you look at that, we have 16 over 116 times 3,706,000. So we have the figure is 511,172. 511,172.4. We round it to all numbers. So with this one, we are going to add back. So then we have VAT on sales, just on that VAT on sales. So we have the figure for the sales. If you look at the figure for the sales in this particular question, the figure for the sales is 5780. That inclusive of sales, that should be 116%. So what is the VAT on sales? We know that the VAT on sales basically overstate. VAT on sales, we know that VAT on sales overstates the taxable income. The VAT on sales basically overstates the taxable income. So we need to understand that the correction is to deduct. The correction is basically to deduct. So if you say that 5,580,000 is equals to 116%. What about that VAT that we need to deduct? VAT, which is 16%. So that should be 16 over 116 times 5,780,000. 5,780,000. So we have this. So that is 16 over 116, then times 578. So that should be that VAT that we need to deduct. That is 797,241. 797,241. 797,241. 797,241. So then we get to the next additional information. Working 2. We're being told the closing inventory was valued at 120. So 1.2, sorry, closing inventory value. So the closing inventory value is 1.2. The figure is 1.2. That is the closing inventory value. The figure is basically 1.2, while the opening inventory was valued at 10% of the net sales. At 10% of the net sales. So we can get the value of opening stock. The value of opening stock. So the value of the opening stock was valued by 10% of the net sales. Net sales basically means net of value added. So the sales we have, if you look at the sales is 5,780,000. This is 116. So net of sales, that should be 100%. So net of VAT. So net of VAT, that should be 100 over 116 times 5780,000. So sales net of VAT, we have our calc, and we say that 100 over 116 times 5780. So what do we have? We have a figure that's 4,982,000, 982,000, and then we have 982,000, then we have 759, 982,759, rounding it to all numbers. So with that we have the net sales. So the opening stock was basically, we were told that the opening stock is basically 10% of the net sales. So opening inventory, we have the opening inventory in that particular question, 10% of the net sales. That's 4,982,759. When you get 10%, there should be 498,275.9. So the opening inventory rounded off to all numbers should be 498,276 to 9. 498,276. That is basically the opening stock. So we're being told that opening stock and the closing stock were both undervalued. Opening stock and closing stock. We say undervalued at 10%. So we start with the opening stock. So this figure, 498,276, is undervalued by 10%, meaning it is 100 less 10. So this is 90%. So what is the undervalue, which is 10%? This is what you call the undervalue. So the undervalue that is 10% should be 10 over 90 times 498 to 76. For 498 to 76. So we get the undervalue, which is 10 over 90 times 498 to 76. So the figure is rounded to all number. That should be 55,364. So when you have 55,364, when an opening stock is basically undervalued, what is the correction? When an opening stock is basically undervalued. Let's have a practical example. We have SP sales, we just say sales 2,000. A practical example, sales 2,000. We have purchases 1,000. We have opening stock 400, and then we have the closing stock 500. So to get GP in this, particularly on this, to get GP, so we have this and this. So we have sales, that should be 2,000. Opening stock 400. Purchases 1,000. Then we have closing stock 500. So when that happens, we have 900. And so we know that when you have 900 there, the gross profit in that case should be 1,100. So if the opening stock in this case is undervalued, let's say we undervalue by 100, 300. What is the implication? What is the effect of undervalue of 100? So that would be now 300 plus 1,000 minus 300 plus 1,000, that is 1,300, minus 500, that is 800 now here. So we have the gross profit rising. So when an opening stock is basically undervalued, the correction is to deduct. It deduct since it overstates profit. Deduct since it overstates the profits. So basically the correction is to deduct since that basically overstates the profit. So the opening stock that is undervalued of 55,364, that should basically be deducted. Then closing stock, we can have the closing stock here. Closing stock at this point. So the closing stock is a figure of 1.2. That was also undervalued by 10, so that's 90%. So the undervalue is 10%. So that should be 10 over 90 times 1.2 times 1.2. When you basically do that, so we have 10 over 90 times 1.2. So the figure should be 133,333. So 133, we have 333, two whole numbers. So when closing stock is undervalued, the effect is that it understates. So we add it back. So it understates the profit, so the correction is to add back. So the correction is basically to add back. So we read the last additional information. Interest include, so the interest, we have a figure of 160 in the paper. The figure is interest. When you talk about interest expense, 166. Interest expense include interest on partner's capital of 120, which was shared according to the ratio. So interest on partner's capital is a non-allowable expense. So we need to note on that additional information, number 6, that 120 is a non-allowable expense that needs to be added back. But you're saying that under what we're going to take under partner's allocation, income allocation schedule, we are going to share this interest on capital based on the ratios. So we can have this working as sharing of interest. Sharing of interest. Interest on partners' capital. Partners' capital. So that's as we call it, we're working through there. So we have worker. That should be, worker is 5/8 times 120. Then we have Baraka. Baraka should be 3/8 times 120. 3/8 times 120. So we get those figures. So 5/8 times 120. So that should be 75. And we are taking them to income allocation schedule. So the other one will be 3/8 times 120. So we have 45. That's okay. We have that as 45. So that marks the end of those additional information. So required. We are told that to compute the adjusted taxable profit of partnership for the year ended 31st December 2023. So that is the first Roman A, B Roman A. So say you worker and Baraka partnership, worker and Baraka partnership. Taxable, what do you call adjusted taxable profit? What do you call adjusted taxable profit for 2023. And we need to understand, because we've been provided with accounting profit, we need to understand that we are going to use the net profit. So we'll say we have this shillings on this. Then we know that in this particular question, we have been provided with an accounting profit. So we use what we call the net profit method. So say accounting loss stroke profit provided. So based on what was done by accountant, it basically said that this business made a loss of 2,750,000. So then we say add back non-allowable expenses in P and L, non-allowable expenses in P and L, non-allowable expenses in P and L. Then taxable, we say taxable incomes not in P and L, and taxable income not in the P and L. So when you look at this, when you look at basically what you have, so we start with the P and L, that is on the expenses. So we have the non-taxable, non-allowable expense that we have for the first one in the P and L, less expenses. We have purchase. We have what we call purchase of computers. We have the purchase of computers. So that's a figure of 216 that needs to be added back. 216. Then we have the next on that P&L. We look at the repairs, no legal fee. Just on that computer softwares and programs. We have computer softwares and programs. So that should be 1.2. Computer softwares and basically programs, that is 1.2. So then we have the first additional information that we have on legal. So we say that legal fee on defense against alleged breach, that is allowable. Then legal fee on tax appeal. We have legal fee on tax appeal. Legal fee on tax appeal, that should be 64,800. Then we have land conveyancy fee, what we call the land conveyancy fee. So the land conveyancy fee, that is 72,400. We also had stamp duty. We also say that stamp duty, that should be 36,600. That is a stamp duty. We can have the last one. Negotiating a business loan. What they call negotiating on this. Negotiating a business loan. That's also non-allowable. Negotiating a business loan, that should be 25,400. That should be basically 25,400. So I hope this is able. This is very visible as we look at that. So because of some entries that we need to have there, and then we have that. This entry we can wrap that we need to add back. That is VAT on purchases. That is basically VAT on purchases. 511. We need, as we wrap it, we need to put it there. So we have VAT. Another item, VAT on purchases. On the purchases, that is 1,511,172. So we go on with where we had signing 100 years lease agreement. So say signing 100 years lease agreement. Signing 100 years, that is more than 99. That should be 128. So we have 128,400. So then we have the next, that is purchase of partners. That is a private purchase of partners. We call it partners private vehicle. Purchase of partners private vehicle. That is a private expenditure. That is 137,400. We have that. Then the last one, we know that legal fee on renewal of patent. Legal fee on renewal, what they call renewal of patents. Legal fee on renewal of patents. So the legal fee basically on renewal of patent. Legal fee on renewal of patent. On renewal of patent, we have a figure of 126. That's a figure of 126. We can clear what you have. We know that we have that figure at the back of our mind. 7. We need to understand that we have it as 797,241, so that we don't go doing the working again. So then we proceed to additional information number 2. We knew that the purchase of furniture is also non-allowable. That should be 260. Purchase of furniture. Then you have designing and partitioning. What you call designing and partitioning. What you call partitioning of new office. Designing and partitioning of a new office. That's also capital expenditure. That should be 341. So that is also added back. And that is okay. So we move to the third. Impairment of patent rights. That's non-allowable. What you call impairment of patent. What you call patent right. Impairment of the patent right. We have a figure of 120. That's also need to be added back. Impairment of patent right. Then provision of general bad debt, also non-allowable. Provision of general, what you call general bad debt. That should be a figure of 208,000. We add that back too. Then we have the last one, drawing of goods by partners. We have drawing of goods, also non-allowable, goods by partners. Drawing of goods by partners. So that should be equivalent to 314. Having a figure of 314. Then purchases, we knew that we needed to add back VAT on purchase because that's understated the profit. On the sales, we are going to less. So we're still looking at what items that we need to add back. So we proceed to opening and closing stock that were understated. We know that what we need to add back is closing stock understated. So we say closing stock understated. We say understated. The closing stock that is understated, That should be 133,333. 133,333. Then we have the last one, that is interest on partners' capital. We call it interest. Interest on partners. We call it partners' capital. Interest on partners' capital. The figure is 120. Interest on partners' capital. The figure is basically 120. So these are the items that we need to add back. What is the total of those items that are needed to be added back? We have 216. We had it 216,000 plus 1.2 down there, plus 64,800 plus 72,400 plus 36,600 plus 25,400. We have that. Then plus 511,172. 511,172 plus 128,400 plus 137,400 plus 126 plus 126 plus 260 plus 260 plus 341 plus 120,000 plus 208,000 plus 314,000 plus 133,33. Then lastly plus 120. So the figure is 4 million. The items that we need to add back, 014,505. That is 4,014,000 and 14,505. So we go to less. Less, we know that we less non-taxable, taxable operating incomes in P&L, comma, investment incomes in P&L, investment income basically in P&L, and what to call and allowable expenses not in the P&L, not in P&L, and allowable expenses not in P&L. So what are we lessing? Non-taxable operating incomes in P&L, investment income in P&L, and allowable expenses not in P&L. And when you talk about allowable expenses not in P&L, this is basically the investment allowance, because we do not have deposition in taxation. So we move to those items. We look at the incomes. So the first one is general bad debt recovery. So we have general bad debt recovery, general bad debt recovery, general bad debt recovery, general bad debt recovery. So that should be 75, the item that we need to less. Then we have anticipated, what we call anticipated foreign exchange gain. Anticipated foreign exchange gain, 180. Anticipated foreign exchange gain. Anticipated foreign exchange gain. So we looked at that as we rotate that camera to that very hand, because of we have that. So then on those incomes, we also have capital gain on sale of land. What do you call capital gain on sale of land? Capital gain basically on the sale of land. That should be 352,000. Capital gain on the sale of land. That is a figure of 352,000. Then insurance recovery. Insurance recovery on stolen vehicle. This is recovery on fixed assets, so that's also non-taxable. That is 320. An item that we also need to less. We have release of liability is taxable. We have now interest on from Ulinzi, what we call Ulinzi Sacco. Interest from Ulinzi Sacco. Interest from Ulinzi Sacco. So Ulinzi Sacco, we know that that's a figure of 34, and that is qualifying interest. So we don't subject it. We do not take it to the income allocation schedule. So then we move on those incomes. We are sorted, but we know that VAT on sales, that was basically overstating profit. VAT on sales we had 797,241. We noted it up there. Then we have the next item, that is opening stock understated. What we call opening stock understated. So the opening stock that was basically understated, that is 55,364. Then we wrap this and move to the investment allowance. Opening stock understated. So as we wrap that, we now move to allowable expenses that are not in the P&L. So that is basically investment allowance. And this is, to be precise, wear and tear. So we can have the first one. We know that we have computers, We have computers. Those should be under investment allowance at the rate of 25. So that times 25% times 216. The investment allowance on that, 25% times 216. 25% times 216. 25% times 216 times 216. So that should be 54. That should be 54. Then we have the next. On the next was computer softwares. We have computer software. That's also 25% at the rate of 25%. That is 1.2. 1.2. That should be 300,000. That should be 300,000. 1.2, that should be 300,000. And then we have what you call, we have furnitures. Furnitures, we know 10%. Furnitures, we know that should be 10%. So furniture, we had, on the furniture, that was 260. If you look at that furniture, furniture was 260. So that is 10%. Furniture times 260 times 260,000. That should be 26, the investment allowance. Then we have partitioning. The partitioning figure was 341. We know that partitioning is also 10%. So times 10%, that should be 34, what we call 34,100. So these are the items that we need to less. So we can get the summation of items that we need to less so that we get the adjusted taxable profit or a loss. So I have 75 plus 180 plus 180, then plus 352 plus 320 plus 34 plus 797, 241 plus 55, 364, then plus 54 plus 300,000 plus 26 plus 34,100. So this gives us what we have as 2 million. So we have 2,227,705 as items that we need to less. So we have the adjusted, what we call the adjusted, but A adjusted taxable profit or loss for the business. Adjusted taxable profit or loss for the business. So we have a loss, a negative of a negative 2, a loss which is that is a negative. So that is negative 2,750,000 plus 4,014,505. So when you had that, then we less, again we less 2,227,705. So what do you have? Adjusted taxable loss of 963,200. That is adjusted taxable loss of 963,200. So when you adjust it, they got it, accountant got it at this, but as we adjust, we know that the loss was basically 963,200. Using the principles of tax, adjusting that, we have a figure of 963,200. So then we can proceed to the next part. We can proceed to the next part. The next part we've been told, allocation of profit or loss. So that is B. We can have that B here. What they call allocation of profit or loss. We stretch as we rotate the camera. We stretch as we rotate to have it on a clean slate. That is basically on this other end, to have it on a clean slate. We have it on the clean slate, but we can just have it on that end. We can just have it on this end. We know that this can be enough. So we have Waka, we have Baraka, we have Baraka, and then we have totals here, and then we have totals on that end. So what do we start with? We start with items that we need to add: interest on capital. So interest on capital, there was a 120 that we were able to divide. The 120 that we were able to divide, as we rotate that camera, we can look at where we did the division or working. That interest on capital was basically 75 for Waka, and Baraka was 45. So we get back and have 75 on this. We have 45 on this. So then now we have a figure of 120. And then we have a figure of 120. Then we have a figure of 120. So then we proceed to the next. Is there salaries to partners? There's no salaries to partners. Is there interest on drawing? There's no interest on drawing. Is there bonuses to partners? We do not have that. So we have a column here. We call it the share of profit. We hold it. Share of profit. We hold it. Share of profits stock loss. The loss. Share of profit stock the loss. We have taxable, operating profit or loss for business. Taxable operating profit or loss for the business that we got from our working. That is basically 963,200. So we have that. So we look there keenly. So this one we call it A. We call this one B, sorry. This one we call B, and this one we call A. And sometimes for this particular question, we were simply having one item, that is the interest on capital. So how do you get the profit of share, which is C? C should be B minus A. So the taxable operating loss. So if you have a loss of 963,200, and then you minus 120. So when you minus 120, we mean that there's a loss that needs to be shared. That loss is 1,083,200. How are they sharing it? As I do the working here, how are they sharing? I do the working here as the camera is being rotated. The ratio is still the same. Even that loss is supposed to be shared. So we have Waka, and then we have Baraka. Waka is having 5/8, and the total loss, as we rotate that, the total loss is 10,83,200. So how much loss goes to Waka? Then Baraka is 3/8, 10,083,200. How much loss goes to that? So we get that. So times 5/8. So the loss that goes to worker, that should be 677. That should be 677. The loss that goes to Baraka, that is 10, 0, 83, 200 times 3 over 8. So the loss that goes there, that should be 406. This should be 406, 200. So we have that loss that basically goes to this. So this should be 677, 677, 677. Then we have 406, 406, 200. So what is the taxable operating income that goes to worker? We remember, under partnership, we do not tax partnership, but you tax basically individuals that are in partnership, So 75, which is a positive, minus a loss that is 677. So what do we have? We have a loss that is 6, that should be 602. That should be 602. That is, and that we also have a loss. The loss is bigger than the positive value. So if we take 45, so the loss basically decreased to 361, 200. So add, we just say add other taxable investment income. We do not have those investment income. There's none. So then we just wrap this again. We get the total taxable. We wrap that to get the total taxable income. Total taxable income. So we have worker, Baraka, and then we have the total. The figure remains the same. So that is 602. That is a loss. That should be 361, 200, which is a loss. So the total loss we know is 963, 200. When that is added, 963, 200. So we cannot, in the first place, we cannot tax even these persons because they're making a loss. They're making a loss. In the first place, we cannot tax partners. The partners, we say we do not tax partnership, but you tax individuals that are basically in partnership. That is how we basically tackle that question. That is question 4. But again, a point of essence, when you're doing these particular questions on calculation, remember it's the entries that count. So a student needs to be very careful and make majorities of entry. I always say that if you can make 75 to around 100% of the entries, you stand a better chance of doing very well in this calculation. And also just to encourage that these calculations are doable and that the perfect way is that students can basically score marks. That is how we basically sort that question 4, and that marks the end of the session that we have. See you in the next session.
Welcome to Manifested Publishers. We offer KASNEB study materials and video lectures.
Candidates, here I am again to continue revising the paper that was tested in May 2019, that is Advanced Financial Management. Having done question 1, 2, 3, and 4, in our today's lesson we are going to tackle question number 5. And this question 5 is in 2 parts, part A and part B. Part A is a question that tests a candidate's knowledge in capital budgeting decision. Part B is a question from the topic mergers and acquisitions. I will read question 5A first, then I'll answer it here on the board. And as we answer these questions, candidates, I need to remind you that the objective of the Advanced Financial Management paper is to enable you at the end of these sessions you should be able to apply advanced financial management techniques in business. That is why you can see some of these questions are practical questions. These are problems that businesses face which call for techniques in advanced financial management. And as an accountant who is training, it should not also be lost on you that the purpose of studying advanced financial management is more than just passing the paper. As you study this paper, make sure you are gaining the skills, the knowledge, and the expertise that is required of you to solve problems that organizations face. Now, question 5A is a problem that requires the knowledge in capital budgeting, techniques in capital budgeting. So let me read the question. It says that Jeza Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 shillings each. Installation costs for all the computers will amount to 80,000 shillings. It is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million shillings to 12,500,000 shillings annually. The computers are expected to last for 10 years, after which they will be obsolete with no resale value. The operations manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. The probability distribution of the useful life of the computers is given as follows. The probability that the computers will be useful for 5 years is 0.2. Probability the computers will be useful for 10 years is 0.5. Probability that the computers will be useful in 15 years is 0.3. The company is in the 30% tax bracket. The company's cost of capital is 24% and uses the straight line method of depreciation. Required, Roman 1, the expected net present value of the project, 4 marks. Roman 2, the standard deviation of the expected net present value, 3 marks. Roman 3, if the net present value of the project is less than 200,000 shillings, the firm will be exposed to financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution, 3 marks. Candidates, here is a problem, okay, that we need to solve. This is a past paper question that was tested in May 2019. The candidates who appeared in that exam were expected to answer this question so as to earn how many marks? These are 10 marks. 10 marks. So candidates, this again I repeat is a problem, and just like any other problem, this problem requires a formula. Every problem has a formula which has to be applied in solving it. So this is a problem that we need to solve, and the past paper question, this is May 2019. This is advanced financial management, question number 5. All right, May 2019, the advanced financial management paper. Part A, we are required to calculate the expected net present value. Okay, we are required to calculate the expected net present value. Expected net present value. Expected. we've been given the cash flows, all right, because we know for you to calculate the NPV of a project, then it's the difference between the NPV or the present value of cash inflows minus the present value of cash outflows. That is the general formula for calculation of NPV. So this is question 5A, Roman 1, expected NPV. Here is the formula. Expected NPV is equal to the NPV of the first alternative. And the first alternative is where the economic life of the computers is 5 years. So the NPV of the first alternative 5 years times probability of the 5 years, okay, probability of alternative where the machine is the machines will last in the business for 5 years, plus NPV of the second alternative, and the second alternative is where the machines have an economic life of 10 years times probability of the machine lasting in the business for 10 years, that is 10, plus NPV of the third option where the economic life of the computers is expected to be 15 years times probability that the computers will last in the business for 15 years. So this will be the expected NPV formula. So candidates, when in an exam, you need to be writing down the formula first, because it's on the basis of this formula that you are going to answer this question. Because even if you are not to answer the whole question, this one can earn you a mark. This part A, you can see there are 4 marks, right? Writing a formula can earn you 4 marks. So, I mean, can earn you a mark. So, candidates, we need to calculate the NPV where the economic life of the computers is 5 years. Then we multiply by probability as shown in the table there. It shows the probability distribution of the useful life of computers is given as follows. Useful life of 5 years, the probability is 0.2, and the other one 0.5, then 0.3. So we'll get the NPV where the economic life is 5 years times that probability. Then we add to the probability, we add to the NPV where the economic life is 10 years and probability for that option. Then we'll add the NPV where the economic useful life is 15 years times the probability of that alternative. So that is what we are going to do. Now, NPV for the first alternative. How do you calculate NPV for the first alternative? NPV for the first alternative will be the difference between the cash inflows minus cash outflows. So we are going to calculate the cash inflows minus the cash outflows. And from this question, we can read that it is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. So these cash flows, because it's annually, that will tell you that these are annuities. It's very important. These are annuities. So these are incremental annuities. These are inflows. So we are going to deduct these inflows for every alternative by, we are going to subtract with the initial cash outlay. The initial cash outlay for every, the initial cash outlay is standard. You can see here that we are told in the second sentence that in order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 shillings each. So this will comprise part of the initial cost. Then down there we have installation cost for all the computers will amount to 80,000 shillings. So the initial cost plus installation cost, that will be the total initial cash outlay. So let's first work out the initial cash outlay. I'm going to have my workings here. These are my workings. Show all workings. Working number 1 will be the total initial cash outlay, and this will be equal to the cost. The cost that will be equal to the cost, that is the purchase cost, which is 1,000 shillings times 8 microcomputers. So this will be equal to the cost of computers plus installation cost. The cost of the 8 computers will be 8 computers times 100,000 shillings plus the installation of the 8 computers we were told in the question is 80,000. So we have 800,000 plus 80,000, which is equal to 880,000. That is the initial cash outlay that we'll use when computing the NPV for each option. That is working number 1. Now working number 1. Now working number 2, we need to calculate the NPV for each alternative. NPV for each alternative. There are 3 alternatives. That is 1, where the economic life of the computers is expected to be 5 years. The second alternative is where the economic life of the computers is expected to be 10 years. Then 3, where the economic life of the computers is expected to be 15 years. So the NPV where the economic life of the computers is 5 years, what is the NPV? The NPV will be equal to the cash inflows, will be equal to the present value of cash inflows minus the present value of cash outflows. That is the formula for NPV. So formula for NPV. We have seen the cash outflow, the initial cash outlay, which is 880,000. So what is the present value of the cash inflows? And we have said that this cash inflow, remember I said, is an annuity. These are annuities. So we are going to calculate the annuities, the annual cash inflow, annual cash inflows. Then we multiply with the present value annuity factor at 5 years, and the discounting rate will be, will be the last sentence there. The company's cost of capital is 24% and uses the straight line method of depreciation. So candidates, these inflows, as we have read from the question, these are annuities. These are annuities. For us to compute the NPV for each alternative, then we need to have the annuities, the annual cash flows for each alternative. And let me have a formula let me have a working for the annual incremental net cash inflows. I'm going to have a working, okay, a working for the net cash inflows. Net cash inflows. We need the net cash inflows for each option. So the net cash inflows will be equal to, this will be equal to, this is, let me just write in full for your revision, annual, let me call it annual incremental net operating cash inflows. This will be equal to this is net, let me abbreviate it, net operating cash inflows. This is equal to, this is an abbreviation of that, incremental net operating cash inflows will be equal to the earnings before depreciation and tax, earnings before depreciation and tax times 1 minus T plus DTS, depreciation tax shield, DTS, depreciation tax shield. So we want to compute the annual incremental net operating cash flows for the three options. The first option, the last option, I want to start with the last one here, is when the economic life is equal to 15 years, when the economic life N is equal to 10 years, and when the economic life N is equal to 5 years. So I want to have a working, just one working for these three options. So what is the EBT, EBDT, earnings before depreciation and tax? It's an annuity, and that is in note number, the second paragraph. It says that it is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. That's an annuity. Earnings before depreciation and tax. This is the incremental. We are working with incremental. Incremental earnings before depreciation and tax will be the difference between 12.5 million and 12 million, which is 500,000. 500,000. That is earnings before depreciation and tax. Then we deduct the tax. This is tax of 30%. So 30% times 500, this is equal to 150, 150, 150, 150, 150, 150, 150, giving us here 350, 350, 350. So these are earnings after tax, okay? Earnings after tax. You have deducted the tax. This is earnings after tax, or we can say this is EB dt 1 minus t. Okay, 1 minus t. 1 minus t. We've multiplied this by that tax, so this is minus the tax. This minus the tax. This minus the tax. Then we are going to add the depreciation tax shield. You see here we have ABDT 1 minus T, EBDT 1 minus T plus depreciation tax shield. We are going to calculate depreciation tax shield for each option. Depreciation tax shield for each option. Depreciation. Now let's go check the information for depreciation. Now it says the computers are expected to last for 10 years, after which they will be obsolete with no resale value. Then the operations manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. 50,000 shillings each. Then the depreciation policy, the last sentence, the company's cost of capital is 24% and uses the straight line method of depreciation. So the depreciation tax shield candidates will be equal to the depreciation per annum times the tax rate. So we are going to have depreciation here will be the DTS. The DTS will be equal to 30%. That is depreciation. That is the tax times depreciation. And since this company is using the straight line method, that will be equal to the cost minus the scrap value or salvage value divided by the economic life. This is the formula for the DTS. The DTS will add to the after-tax earnings. Depreciation tax shield for the first option. The DTS for the first option, let me do it here. The DTS for the first option, where the economic life is 5 years, will be equal to 30% times the annual depreciation. The cost remains 880 minus the salvage value. We read that the salvage value will be 50, after which they can be disposed of at 50,000 shillings each. 50,000 shillings each. Each computer will be disposed of at 50,000 shillings each, meaning the salvage value of the 8 computers will be 50,000 times 8. 50,000 times 8, then we divide by 5 years. 5 years. So this will give us the DTS, which is equal to this is 880 minus this is 400 minus 400 divided by 5 times 30%. I'm getting 28.8. So the depreciation tax shield 28.8. That is for the first option. The second option, the DTS, where the economic life is expected to be 10 years, equal to 30% times 880,000 minus 0. We read the economic life is 0, then divide by 10 years. 10 years. So I'll have 880 divided by 10 times 30%, getting a 26.4. 26.4. Then lastly, DTS, where the economic life is 15 years, is equal to 30% times 880 minus 880,000 minus 0. The salvage value under this option is 0. Divide by 15. Divide by 15. So I'll take 880 divide 15 times 30%. This is equal to 17.6. 17.6. So after that, what am I going to do? I'm going to add this cash. This depreciation tax shield, I'm going to add it to the earnings after tax to get what we call the net cash flows, annual net cash flows. This will give us the annual net cash flows. Annual net cash flows is equal to EBDT times 1 minus T plus DTS. So let us add. I have 117.6 on my machine, so I just add the 350 to get 367.6. Then I add 350 to 26.4, 376. This is cannot be the same. This is 350 plus 26.4 plus 26.4, 370. I'm getting here 376.4. 376.4. Then I add 350 to 28.8. 350 plus 28.8 is equal to 378. 378.8. These are annual net cash flows. Annual net cash flows, meaning these are annuities. These are the expected cash inflows at the end of every year. And why are we calculating these annual net cash flows? So that we can calculate the NPVs for each alternative. NPV for each alternative. So that is important working there. So I'll come here and have other workings. I can have more workings. Okay. So candidates, you are going to begin with the calculation of the NPV of the alternative where the computers are expected to last for 5 years. 5 years. And I've just said these annual net cash flows are annuities. Annuities, annual net cash flows. These are cash flows. Here we have cash flows, cash inflows minus cash outflows. The cash outflows we had calculated will be 880,000 for the 3 alternatives. But for the cash inflows, they will vary, and you can see we have the annual net cash flows which are different. Another point to note before we calculate the NPVs is that we need to check if there are any other cash inflows. And these cash inflows, as usual, will always comprise, in most cases, the terminal cash flows. Terminal cash flows comprise the salvage value. If any machine will be disposed of at the end of the economic life, then that is a cash inflow. That also would include the net working capital to be recouped. In this question, we do not have the working capital elements, but we have the salvage value for the first alternative. Salvage value, remember here, was 50,000 shillings was to be raised at the end of the 5th year per computer. And that, if I can read from note number about the marketing manager down there. On the other hand, the marketing manager argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. That means that the total salvage value, which will be equal to the total cash flows, terminal cash flows, will be equal to 50,000 shillings times 8 computers, which will be equal to 400,000, which we calculated here. So for the first alternative, the NPV for the first alternative, where the economic life is 5 years, the present value cash inflows will comprise this annuity of 378,800 plus the salvage value. So the NPV will be equal to the NPV for the first alternative. This 5 should tell you that is the first alternative. That is equal to the annuity, this annuity, 378.8 times the present value annuity factor. The discounting rate we saw from the question is 24% at 5 years. This is the present value of the annuity, and we will read this from the tables. Then we will add the present value interest factor at 24%, 5 years, times the salvage value of 400,000. Then this sum, this will comprise the present value of the cash inflows. Then we deduct the cash outflow, which is 880,000. This is the initial. That will be the initial cash outlay. So we can insert the inputs. We have the annuity here, that is 378.8. 378.8 times the factor, which can be read from the tables. From the table, the annuity, present value of an annuity, 24%, 5 years, 24%, 5 years, 24%, 5 years. The factor is 2.7, 454 plus the present value, 24%, present value interest factor, 24%, 5 years. So I have 3411, 0.3411 times 400,000. All right, this we are going to subtract 880,000. So I look for my machine and get the answer. So here I'll have 378.8 times 2.7454 plus 0.3411 times 400 minus 880. So the NPV here is equal to 29. Let me put the units. These are shillings. These are shillings. 29 shillings. 296,398 shillings. That is NPV for the first option. The second option, NPV, where the economic life is 10 years, will be equal to the annuity times present value annuity factor 24%. How many years? These are 10 years. 10 years minus 880,000. The annuity is 376.4. 376.4 times the annuity rate from the table. This is an annuity, 10 years, 24. 10 years, 24, this is 3.6819. 6819 minus 880. So let me do the calculation. 376.4 times 3.6819 minus 880. This is equal to 505,867. Next is the NPV. NPV for the economic life of 15 years, you have the annuity times PVAF 24%, 15 years. 15 years. 15 years minus 880,000. This is equal to the annuity 367.6 times the annuity 24%, 15 years. 24%, 15 years. This is 4.00, 4.0013 minus 880. 880. What is the NPV? The NPV will 367.6. 367.6 times 4.0013 minus 880. Minus 880. This is equal to shillings 590,878. So these are NPVs. The NPVs for each alternative. Alternative 1 is where the economic life is 5 years. Alternative 2, the economic life is 10 years. Alternative 3 is 15 years. And why are we calculating these NPVs? Is so that we can answer the question which required us to calculate the expected NPV. The question is, let me read it. The question is, let me go back to the question. Expected net present value of the project. Expected net present value of the project. How do you calculate that? We had the formula. NPV of the first alternative, which we have, so we can insert the inputs. We have 296,398 times the probability. From the question, we have the probability of 0.2. Was it 0.2? Yes, 0.2. 0.2 plus, this plus Probability is 0.3. The NPV, second alternative, 505,867 times 0.5, is it? Yes, 0.5, plus the probability where the economic life of the machines will be 15 years. The NPV is 590,878 times probability of 0.3. So this will be the sum of the three will give us the expected NPV. 296, 398, 398 times 0.2 plus 505, 867 times 0.5 plus 590, 878 times 0.3. So the expected NPV is shillings 489,000 477. That is the answer, and that would earn you how many marks? 4 marks. 4 marks. All right, those are workings, which would help you earn how many marks? 4. All those workings are to help you earn how many marks? 4 marks. So that is part 1. Required Roman 2, the standard deviation of the expected NPV, the standard deviation of the expected NPV. 2, this is the standard deviation. Let me write it properly. Number 2 is the standard deviation of the expected NPV. I'll summarize it as standard deviation of expected NPV. Standard deviation of expected NPV. Now, the formula for the standard deviation of expected NPV will be equal to the square root of the summation of the values n is equal to 1, NPV, these are deviations, okay? We get the deviations, NPV minus expected NPV. We will square the deviations, then multiply by the probabilities. So we are simply going to get the deviations because we have the NPVs for each alternative. These are the NPVs for each alternative. And we have the expected NPV. We have it. We get the deviations, square the deviations, and then multiply by the probabilities. So candidates, I'll start with have a column for probabilities. We have the probabilities. This is 0.2 for the first option, 0.2, the third option, 0.5, the second option, the third option, 0.3. Then I'll have another column for NPV. You have NPVs for each option. We subtract with the expected NPV, which you have calculated here, expected NPV, we will then square the deviation. This will give you the deviation, okay, the deviation from the expected NPV. Then we will multiply with the PI. We multiply with the PI, then we'll get the summation. Going to do the summation here. So let me be economical. Let me be what? Economical. We are calculating the standard deviation. So let's start with the first option where the NPV is 296, 398, 296, 398 minus the expected of 489, 477. So I have the deviation, which is a negative. Then I square it, then multiply by probability 0.2 times 0.2. So I'm getting here 7,455 455 900 048. The second option, 505 is the NPV, 867 minus expected 48,947. That is the deviation. I square the deviation, then multiply by 0.5. The answer here is 134,316. 134,316, 050. 050. Then lastly, the NPV for the last option, 590. 590, 878 minus expected NPV, 489, 477. I'll square the deviation, then multiply by probability of 0.3 to get 3,084, 64, 840. Then I'll get the summation. I'll add these three. So when I add, this is equal to, that is 745590048 plus 134316050 plus 308,464,8840. So I have the total there. Then let me do the standard deviation. The square root. The square root of this total is let me just do the square root of this total is equal to, so the answer, candidates, the square root is the standard deviation is 103,319 .238. That is the standard deviation of the expected net present value. And that we've answered part 2. Now, part 3 says, let's answer part 3. It says if the net present value of the project is less than 200,000 shillings, the firm will be exposed to a financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution. 3 marks. Determine the probability. Let me rub here. Determine the probability that the firm will avoid financial distress. Probability that the firm will avoid financial distress. And if the net present value of the is less than 200,000, the firm will be exposed to a financial distress. If the net present value of the project is less than 200,000 shillings. 200,000 shillings. Determine the probability that the firm will avoid financial distress. This is part 3. Part 3, probability that the firm will do what? The firm will avoid financial distress. So learners, for us to calculate the probability, first we are going to calculate the Z score or the Z value, and we know that the Z value or the Z score is equal to X, which represents the actual value. In our case, that will be the 200,000 shillings minus the mean mu divided by standard deviation. In our case, this is the general formula for calculating the Z score. In our case, the X will be the NPV of 200. That is at the point where the firm is likely to avoid distress. We've read that if the net present value of the project is less than 200,000 shillings, that will be the value for X or the NPV. Then the mean is the expected, that will represent the expected NPV. Expected NPV, that is expected NPV divided by the standard deviation of the expected NPV, the standard deviation of the expected NPV, which we have calculated here. We have the mean or the expected NPV, and we have the 200,000 shillings minus the mean of 48,947 divided by the standard deviation 103,319. This will be the Z score. So let me take my machine, and I can see there that is a negative. That is negative. It's a negative of 200,000 minus 48,947 divide 100. This is 103,319. This is equal to 2.8017. If I was to round it to 2 decimal places, this would be equal to 2.80. This is to 2 decimal places. So this Z value, we will now, candidates, read from the standard normal curve. The standard normal curve the 2.80 as read from the normal curve, the value here is 0.4974. Now, candidates, if you are to draw the curve, let me just draw the curve to explain how we will arrive at the probability that the firm will avoid financial distress. If you are to do a normal curve, this is what we will have. This is what we are going to have. Our mean value, NPV. NPV here is at this point, and the amount, the value there is 489,474. We all know this region represents probability of 0.5%. This is only 0.5%. 5%. So, what is the probability that the firm will avoid financial risk? Okay, if the financial distress, this is financial distress. If financial distress, we learn from the question, we read from the question that if the net present value of the project is less than 200,000 shillings, if the NPV is 489, that is the expected NPV, this is the mean, we say this is the mean. If the mean NPV is at this point, and we read that what is the probability that the firm will avoid financial distress if the NPV is 200? Because if the mean NPV is 489, then the 200 will be this side, on the left-hand side, because we're counting, assuming this is a number line, this will be 200,000 will be at that point. 200,000 will be at this point. We know that this is a probability of 0.5. So we need to calculate the probability that the firm will not get into financial distress, and that has to be this region, okay? This region, because this region if the region below 200,000, this is the region of financial distress. But you want to calculate the probability that the firm will not be exposed to financial distress. Financial distress. The firm can only be exposed to financial distress if the NPV is less than 200,000 shillings, and this is this region. Any amount of NPV beyond this region is safe. The firm will not be exposed to financial distress. Therefore, the probability of avoiding financial distress will be equal to the 0.5 plus 0.49 0.4974, which is equal to 0.5 plus 0.4974. This is equal to 0.9974. That is the probability of avoiding financial distress. In percentage, this will be 99.74% probability of avoiding financial distress. So that is how such question should be answered. And candidates, I'm done with the first part of question 5 of the May 2019 sitting. We are going to take a short break. When we come back, we'll answer question 5B. Go through the question once more, and again, there were similar questions that have been set in relation to this advanced capital budgeting question. Thank you, and hope to see you in our next session, where we'll complete this sitting by doing part B of question 5, May 2019. Bye-bye.
Welcome to Manifested Publishers. My name is Mr. Bernard Mariga. I'll be teaching you advanced management accounting, and today we will go to a question on December 2024. December 2024. 4C. Let's go to question 4C. Should be question 4C. Though we will need to use information on 4B. 4C is saying Lambda Investment Enterprise Limited is contemplating acquiring perfect information from an investment research firm about the viability of the investment opportunities. The investment research firm is willing to provide perfect information about the investment project at a cost of 30 million. Required. Using suitable computations, advise Lambda Investment on whether or not to acquire the perfect information from the investment research firm. All right. Now, so what we need to do is we determine our value of perfect information by getting the expected monetary value with perfect information minus the expected monetary value without perfect what? Information. So, as to do that, we need to prepare our a payoff table. So let's have the states of nature, or states of nature, and in this case, your states of nature were what and what? Remember, your states of nature, we've said, they are those events that cannot be controlled by management, and they should have prior probabilities if you're dealing with risk. And this was your economic conditions. This is your economic conditions, which was optimistic with a probability of 0.3, most likely with a probability of 0.4, and pessimistic with a probability of 0.3. Your decision alternative was here, or will be here. You can either invest in corporate, shopping mall, and lastly, residential area. And then we now represent our payoffs. Let's represent our payoffs. 100,000, 70,000, 130,000, shopping mall, 110,000, 90,000, 90,000, residential, 90,000 is your payoff. 120,000 and 70,000. 170 what? 1,000. Now that we have drawn our what? Payoff table, let's determine our expected monetary value with perfect information. Your expected monetary value with perfect information will require that you select the highest payoff for each state of what? Nature. For optimistic, that is your highest payoff. For most likely, that is your highest payoff. For pessimistic, that is your highest payoff. Then these highest payoffs here, you multiply by your probabilities. Why? If you knew under optimistic that the shopping mall is the best decision you could make, there is the most likely chance or the best decision is to choose what? Shopping mall. If under most likely you knew that the residential results in the most payoffs or the highest payoff, you're going to select what? Residential. In pessimistic, if you had enough information and knew that the corporate is the one with the highest what? Payoff, you would have selected what? Corporate. And that is why we say this expected monetary value with perfect information, which is your maximum payoffs of each what? State of nature. Then you multiply by your who? Probabilities. Remember, expected, you must multiply with your probabilities. And how will that be? You're going to say it is 110,000 with a probability of 0.3 plus 120,000 with a probability of who? 0.4 plus 130,000 with a probability of 0.3 with a probability of 0.3. 110 by 0.3 plus 120 by 0.4 plus 130 by 0.3. So expect how much? That your expected monetary value with perfect information will be how much? Will be 120,000. The next thing I want us to do is to determine your expected monetary value without perfect information. Expected monetary value without perfect information. And the expected monetary value without perfect information is simply your EMV, your maximum expected monetary value. And how did we get your expected monetary value? You simply take your payoffs by the probability. For example, corporate. We have done this previously. Corporate, you're going to take 100,000 by who? By 0.3 plus 70,000 by who? 0.4 plus 130,000 by 0.3. Then shopping mall, 110,000 by 0.3 plus 90,000 by 0.4 plus 90,000 by 0.3. Residential area, 90,000 by 0.3 plus 120,000 by 0.4 plus 70,000 by 0.3 by 0.3. 100 times 0.3 plus 70 times 0.4 plus 130 times 0.3. This should be 97,000. Shopping mall, 110 times 0.3 plus 90 times 0.4 plus 90 times 0.3. That should be 96,000. 90 times 0.3 plus 120 times 0.4 plus 70 times 0.3. 96. But remember, using the expected monetary value approach, you normally select the one with the highest. So this is what? 97. This is your EMV. 97, 96, and 96. So you select the highest. That is the highest. Okay. So therefore, the expected monetary value of perfect information will be your expected monetary value with perfect information of how much? 120,000 minus your expected monetary value without perfect information, which is the highest EMV, which is 97,000. So 120 minus 97, which is how much? 23,000. 23,000. 23 what? 1,000. That is the value that you expect to obtain when you acquire perfect information. When we say acquire perfect information, is where you can hire a company. Then when you hire that company, the value they will give you is worth how much? 23,000. But part C of that question, they are asking advice on whether or not to acquire perfect information. So here what you will do, you will simply now compare the value of perfect information and the cost of acquiring that perfect information. The cost of acquiring perfect information is how much? 30 million, so 30,000. So when you acquire perfect information, it will be worth how much? 23. But how much do you expect to incur for it? 30. So therefore, what will you advise them? You will advise them, do not acquire perfect information. Why? Because it is more expensive to acquire than the cost you're going, than the value you're going to obtain, So you're going to advise them not to acquire perfect information because it is far much expensive. The cost outweighs the value you obtain. That is how you deal with expected value of perfect information, but using what? Payoff table. Using payoff what? Table. So remember, it is simply the difference between expected monetary value with perfect information minus expected monetary value without perfect information. And you've said the expected monetary value without perfect information, simply you must determine your EMV, expected monetary value, then the maximum. I hope that is clear.
Welcome, candidates. Today we are going to answer question 2. The subject, Advanced Financial Management, November 2020. Question 2. In our last session, we answered question 1. Question 2A, I read, the following information relates to 2 mutual funds operating in your country. Omega Mutual Fund and Beta Mutual Fund. The realized return, 13% Omega Mutual Fund, 18% Beta Mutual Fund. Beta, 1 for Omega Mutual Fund, 2 Beta Mutual Fund. Standard deviation, 19% Omega Mutual Fund, 15% Beta Mutual Fund. Additional information, number 1, the return on the market index is 12%. Number 2, the risk-free rate is 8%. Required for each of the above mutual funds, compute the following performance index scores. Roman 1, Jason's Alpha, 2 marks. Roman 2, Trenos Alpha, 2 marks. Roman 3, Sharp Index for the funds and the market, 3 marks. This is question 2A. You have to compute for each mutual fund, Jensen Alpha, Trenos Alpha, and Sharp Index. Roman 1. So candidates, as usual, it's important to put down the formula. The formula for Jensen's Alpha. The first one, Jensen's alpha. The formula is R, the return of portfolio minus R risk-free, this is risk-free, plus beta RM minus RF minus RF. Jensen's alpha. Now, candidates, Jensen's alpha was developed by Michael Jensen. That's where we get the word Jensen. Jensen is a person whose other name is Michael. It was developed in 1968, and the purpose was to measure the difference between a portfolio's actual return and its expected return according to the KPM. According to the KPM. So that's the formula. So let's work out the Jensen's alpha for the first company here is Omega. Omega's return on portfolio is return on portfolio. Realized return is 13%. 13% minus Omega's, this is Omega's risk-free, and that the risk-free is just the treasury bill is 8%, that is 8% plus beta omega beta is just 1, substituting the values in the formula candidates, 1 into the market return. The market return is 12% minus 8%. That will give us the Jensen's alpha for Omega fund. Then we do the same for the next fund, which is beta. The risk-free, the return on beta mutual fund return is 18%. 18% minus risk-free remains 8% plus beta 2 times the return, market return 12% minus the risk-free 8%. That will give us the Jensen's alpha for Omega and beta. These are fund, beta fund. Then the next candidate is Trenos alpha. Trenos alpha candidates, the formula is the portfolio return minus risk-free rate divide the portfolio beta. Going to the question, the return Omega realized return is 13%. 13% minus risk-free 8% divided by beta of 1. How about beta fund? Beta fund return is 18%. 18% minus risk-free 8% divided by 2. Then I'm going to calculate the other measure, which is sharp index. We know the formula, candidates, is equal to the portfolio return minus the risk-free divided by the standard deviation of the portfolio. For the return on Omega fund is 13% minus risk-free 8% divided by standard deviation. The standard deviation Omega 19%. Next we have, that will give us the answer here. Then we have sharpest for Omega beta fund. Beta fund, the return 18% minus 8% divided by the standard deviation 15%. 15%. Then lastly, candidates, is the market. Sharpest index for the funds and the market. The sharpest index for the market, sharp index for the market, will have, this will be equal to, sharpest index for the market is just the market return. The market return will be equal to the market return on the market minus the risk-free. Then we divide the market standard deviation for the market. So candidates, is important you have the formula in your head so that you can retrieve it anytime. So when faced with such a question, first of all, you put down the formula, then you check the inputs from the question and insert in the formula. Then the rest is the work of the machine. The machine will do the rest of the work. For example, here we want to calculate the Jensen's alpha for Omega fund. That will be equal to one. Beta fund, this is equal to 2. Trenos alpha is 5. This is 18 minus 8, 10 divided by 2, 5. Then sharp for Omega fund, sharp index Omega fund, 0.263. Then here we have it's equal to 0.666. For sharp index candidates, we have the market return. Sharp index for the market, we'll have the market return. The market return is 12% minus risk-free of 8% divided by the standard deviation for the market. Now, candidates, the question did not provide the standard deviation for the market, and that seems to be an error of omission. So we are going to assume a standard deviation of 25% for the market. Okay, 25% for the market. 25% for the market, that is 12 minus 8 divide 25. This is 0.16. So we have assumed a standard deviation Standard deviation for the market is 25%. This is not provided in the question yet, candidates. For you to calculate the Sharpe index for the market, you require the return, market return, you require the risk-free rate and the standard deviation for the market. So candidates, that is part A. Part A, how many marks are these? Part A, we have Jensen's alpha, 2 marks, 1 mark, 1 mark. Trenos alpha, 1 mark, 1 mark. Then Sharpe, 3 marks, 1 mark, 1 mark, 1 mark. Total, these are 7 marks. 7 marks. 7 marks. 7 easy marks. 7 easy marks. The marks are easy if you have the formula. And you can see if student who had the formula, then it becomes easy to calculate these measures. Jensen measure, I said earlier, is a measure that we get after, is a measure to calculate the difference. It's a measure to calculate the difference between the portfolio actual return and its expected return according to KPM. Now, Trenos alpha, on the other hand, provides a measure of performance adjusted for market risk. That means it shows the return earned over the risk-free return per unit of market risk. And candidates, the higher the Trenos ratio, the better the performance of the fund. And you can see these funds have equal performance. They are performing equally because both have a ratio of 5:5. Now, candidates, the Sharpe's index measures how much a fund has returned for each unit of risk taken. Sharpe's index measures how much a fund has returned for each unit of risk that is taken. Now we are going to answer part B, which says the estimated factor sensitivities of Diamond Limited to farmer fringe factors and the Pastor-Stamber model factors and the risk premium associated with those factors are given in the table below. There is a table, there is a column on factor sensitivity and risk premium in percentage. The first one is a market factor, then there is a size factor, the value factor, liquidity factor, and the treasury bills rate is 5%. Required, Roman 1, the required rate using the farmer fringe model, 3 marks. Roman 2, the required rate of return using the Pastor-Stamber model, 3 marks. 3 marks. This is part B. Farmer fringe. Farmer fringe return. We need to calculate farmer fringe, the required rate of return using the farmer fringe model. Farmer fringe model. Now, candidates, this farmer fringe model is a work of Eugene Farmer and Kenneth French. Eugene Farmer and Kenneth French. That this model addresses the perceived weaknesses of the KPM. And there are 3 main factors in the farmer fringe model. And these factors are abbreviated as RM, RF, RM, RF. RM, let me just do some small introduction to this model. RM RMRF. This is the first factor. The next factor is the SMB factor. Then there is a HML factor. There are 3 factors. Okay. This researcher, they were researchers. These 2 researchers, in not quite long ago, in about 1990 or 1993, thereabout, the Eugene Farmer and Kenneth French addressed the perceived weaknesses of the KASNEB model with 3 factors, which are known as the Farmer-French model. RMRF is one of the factors, and RM stands for the return on market. RF stands for risk-free. Okay? The risk-free, or the 3 months treasury bill. The 3 is a 3-month treasury bill, and is one of the equity risk premium that can be presented, and is a factor that is shared with the KASNEB. Okay, the premium, we know candidates in KASNEB, we know that premium is equal to the return on the market minus the risk-free rate. This is what it means, RMRF. That's the first factor. Then SMB candidates, small minus big, or a size, or what we call market capitalization factor. It is the average return on 3 small cap portfolios minus the average return on 3 large cap portfolios. So the SMB represents a small cap return premium, a small cap return premium. How about the HML? The HML candidates is a high minus low. That is the average return on 2 high book to market portfolios minus the average return on 2 low book to market portfolios. All right. Now, if you are to put this in a formula, candidates, the Farmer-French return, can be calculated as follows. The Farmer-French return will be equal to the risk-free rate plus sensitivity plus sensitivity to equity market factor times the equity risk premium, plus sensitivity to size factor times the size risk premium, plus candidates sensitivity to value sensitivity to value, times value risk premium. Value risk premium. That's the formula to calculate the return based on the Farmer-French model. You can see we have risk-free plus, these are 5 things. 1, 2, 3, 4. There are 4. 1, 2, 3, 4. 4 inputs. Number 1 is the risk-free rate. Then there is sensitivity to equity market factor. Equity market factor times equity risk premium. Equity. That's how you relate these things, candidates. Then there is plus sensitivity to size factor. Size. The premium here is the size risk premium plus sensitivity to value factor. We have value times value risk factor. Value. So we have equity, size, value. So let us now get these inputs from the question. Get the inputs from the question. First of all, we have the risk-free rate. 5%. That is the treasury bill rate, is the risk-free rate. We add sensitivity to equity market factor. Sensitivity to equity market factor is 1.05 times its premium, 1.05. The premium is on the right hand side of the third column of 5% plus the sensitivity to size. Size is the next factor, sensitivity to size factor, that is negative 0.65 times the factor, size factor 2.5 plus the sensitivity to value. The next one is value negative 0.2 times the value premium 4.5. That will give us the return based on the Farmer-French model. Next step is to use the machine. That is equal to 7.725. 7.725. That is the return. 7.72%. 7.725%. Now, candidates, you can see there are 3 main steps here when calculating this kind of a question, when finding the return based on the Farmer-French model. The first step, put down the formula. That's the formula. Put down the formula. Then the next step is to insert the inputs from the question. Okay? From the question we substituted these values from the figures in the question. So that's step number 1, then step number 2. The third step is to use the machine. You are allowed to use a calculator in your exam. Use a machine and then just get the marks. These are how many marks? 3 marks. These are 3 marks. 3 marks. 3 marks. It's a mark for that step. Formula, it's a mark for the formula. Then there's a mark for identifying the right inputs, then calculation. We are now going to answer the second part of B. We've done the Farmer-French, the required rate of return using the Farmer-French. In part B, we are going to calculate the required rate of return using the Pastor-Stumble model. Pastor-Stumble model Roman 2. Now, what is this model all about? Candidates, the Pastor and Stumble, these are again two persons, researchers, Pastor and Stumble, which is a more recent model. The other one, this French model, I said it was about 1993. This one is about the year 2003. In the year 2003, Pastor and Stumble extended the Farmer French model to encompass compensation for the degree of liquidity of equity investment. And this model is mostly applied to the public security investment as well as certain private security investments. So the Pastor-Stumble model adds to the Farmer French model a fourth factor. These are three main factors. This is the market factor. We have the size factor. Then there is the value factor. This model adds the fourth factor, which is the liquidity factor. That's why in this question, the fourth factor there is the liquidity factor. So the model is just the same, apart from the fact that the Pastor-Stumble model adds the fourth factor, which is the liquidity factor. So the return based on the Pastor-Stumble model will be equal to risk-free. Let me use my blue pen, or let me just use my black pen. The risk-free will be equal to the risk-free rate plus sensitivity to equity market times equity risk premium, plus sensitivity to size factor times size risk factor plus this is 1, 2, plus the third one is the sensitivity to value factor times value risk factor plus the fourth factor, which is in this table here, the liquidity factor, sensitivity to liquidity factor times the liquidity risk factor, That will give us the return based on the Pastor-Stumble model. So you have the return is equal to the risk-free rate plus sensitivity to equity market times equity risk premium plus sensitivity to size factor times size risk factor plus sensitivity value factor times value risk factor plus sensitivity to liquidity factor times liquidity risk factor That is the formula. You can see here we have equity market factor. Then we have equity risk premium. Then here we have size factor. We multiply by the size risk factor. The other factor is the value factor. We multiply with the value risk factor plus sensitivity liquidity factor times the liquidity risk factor. Liquidity risk factor. So we are going to go to the next step, which is to insert the values. And candidates we saw